Morning, everyone. This is Rajendran here, joining from Market Calls, and welcome everyone to webinar on learning order flow. So we're going to see in-depth basics about order flow, what order flow is all about, how you can make use of those information, what to observe order flow on day-to-day basis. That is what we are going to discuss in the first half and the second half. We are going to look into some of the strategies, and most of the strategies will be discussed on the 24th or 25th. There is one more session. There's one more complete one-day session coming on order flow. There we are going to discuss most of the trading strategies. But today's strategies is all about the basics of learning about order flow. Before getting into the session, just give me a quick confirmation. Is the audio quality and video quality is good, so that we can move ahead?
Yes, Master.
Yeah, thank you. So, this is a brief history of technical analysis, where the 17th century, where we got introduced to candlestick studies from the Japanese rice traders, and then from 1920s is what we got the concept of Elliott wave, where it combines the psychology of the markets with the tools like Fibonacci kind of tools, and Elliott wave is all about trying to understand the mass psychology. And it's a study combined with mass psychology. And then comes the price action studies. Price action studies, it talks about supply and demand on the bar charts, and it mostly it talks about the price behavior and where the pending orders are there. It's more of a 1930s where the it's been mastered by Richard Wyckoff, and we are not going to talk about those things. So we are going to talk about something modern. Next comes the market profile, which is something new, just been invented in 1985s in the floor trading era, right? But it's also, again, talks about the auction behavior in the markets, how the traders behave. So, but then for market profile kind of tools, the software tools started coming up from 2005 onwards, if I remember rightly, because prior to that we don't have any excellent software tools to plot market profile kind of stuff. So market profile, even though it is practiced on the floor in 1985 by Mr. Peter Stadelmayer, it has came to limelight after 2000, after the invention, after once the market becomes completely electronic. That is where the market profile comes into limelight. Then next comes the order flow, right? Order flow, it's a new concept. It has been talked about during 2002s, where people came up with the idea of volume at price. Truly, we don't know who the inventor was till today, but this was discussed in one of the Squawk box during 2002 about putting volume at each and every price levels and trying to study it. And the real software came during 2012. They call it as a footprint when it is introduced in 2012. Means it's almost 6 years old, 6 to 7 years old from now. And the very first software which came was Market Delta, right? So during 2012, and I get a hang of Market Delta during 2013 onwards. I tested for closely 6 months. I'm not able to understand what exactly is going on because by that time I was very new to the auction markets. I really don't know what this tool is all about, but I know only it shows what the buyers sellers are doing in terms of numbers. Where I know that only you can spot where the big volume is coming in, where the big order is coming in. So that's the only thing I will be able to gauge it. But otherwise, when I tested closely for 6 months. I gave up for the very first time when I tested, because it's a costly software. During 2012, Market Delta, 2013, Market Delta supports only e-signal. So Market Delta, it's $175 per month. And till today, it is $175 per month. And e-signal, again, you have to spend another $200 per month for getting the order flow charts, because during 2013, eSignal is the only platform who provides tick data for Indian markets. Locally here, global data feeds or True Data, they don't provide tick charts. Very recently, they started supporting tick charts. They are almost last one year they started supporting tick charts. Otherwise, Order flow, it's a costlier tool if you want to try out order flow. And closely 6 months, it would have been costed me somewhere around 2 to 3 lakhs in trying it out. And then I gave up. I gave up, and then I started focusing on market profile first. I thought like this order flow, it's not going to work out unless you learn market profile. That is where the market profile focus initially comes on. Once you get thorough about how the auction happens in the markets, how the buyers and sellers interacts. So order flow is the basic study if you want to move to order flow. Otherwise, you can also pursue order flow as the right as a standalone tool also. That there is no doubt about that. But if you already pursued market profile, then order flow is an kind of an add-on study to you. It enhances your thoughts about how the auction happens, how the buyers and sellers interaction happens. Order flow even talks at the minor level. Of course, there are no books at this point of time because everywhere the experiment is going on there, and institutions are using it, but it's not a mass study as of now. It's not a mass study, something like an RSI or linear wave as of now. And what you have to do is that you have to cultivate your own frameworks. It's more of a screen time observation is required, and it's going to take a lot of time. And at the same time, what you have to do is that you have to record whatever the observation you're going to do. So what I'm going to show in this webinar is how to observe order flow. What are the key information you have to look out for order flow on day-to-day basis, so that you can try to learn any kind of stocks or any kind of indices, what exactly you should watch. Right? That's the basic framework you're gonna get it today. Along with that, the 10 to 12 strategies which we observed, which have a reasonable edge in the markets when you are trying to look into order flow. That's we are going to discuss in today's session. Right. So what is exactly order flow? Order flow is again a visualization tool like market profile. Market profile is also a visualization tool, right? Market profile talks about how the buyers and sellers interact. But order flow is even more a microscopic visualization tool to understand what the aggressive buyers or aggressive sellers are doing in the markets. When I say aggressive buyers or aggressive sellers, what I mean is how it's nothing but a visualization of a market orders, how the flow of market orders is coming into the markets. It's a visualization. It is a visualization tool to understand how the interaction between the buyers and sellers happening at each and every price levels. It is nothing but you put a microscope or you put a microscope inside the candlesticks and you look into the volume at each and every price level of that particular candlesticks. It is a tool to study the auction behavior. Again, it is just like market profile, which is a tool to study the auction behavior. Order flow is also one of the tool to study the auction behavior, how the auction happens in the markets, how the auction pulls the market up and pushes the market down. It's kind of a study. It is a study mostly focused on what is happening in the market right now, right? So we don't care about what has been happened last week, what has been happened 2 years back. We don't care about it. We only bothered about what is happening right now. Or max to max, we care about what happened yesterday, right? What happened yesterday and what is happening right now. That is the only focus. We don't even bother about what happened 2 weeks back or 3 weeks back. We don't get reference level from a 2 weeks back what is happening. So it's mostly focused on a futuristic model where we mostly talks about what is happening right now and how I can play this game better. What is the current trading behavior which is going on? Whether what kind of big order flow you are seeing, where the momentum players are positioning themselves. What is the stop hunting is happening in the markets or not? If the stop hunting behavior happens, then how the auction is supposed to happen? Where the trapped buyers or sellers? So there are many things we can observe from order flow, and it can also be combined with classical technical analysis tools. But it will be work best when you're combining with market profile and order flow. It combines best. Or you can also combine order flow with VPA analysis, because VPA, volume price analysis, is also a volume-based study. So there are a couple of traders who do order flow, they also have a pretty good knowledge on volume price analysis. I don't. I'm not a volume price action analysis player, but who is having a good flow on who have a good idea on order flow can also tag with volume price analysis, or who is already good in price action, they can combine with order flow. So these are the combinations which mostly works. So order flow with market profile, that is what I prefer. That is what I am doing. You can also combine order flow with price action analysis. That's what many other people are trying to explore. And order flow plus price action, because it complements price action based studies, because they talk about pending orders, pending limit orders. Price action talks about it, but order flow, you can visually see what is happening into it. Price action is more of a theoretical approach, but order flow is more of you can visualize whether it is happening there or not in front of your eyes. So what order flow explains is how the orders are coming into the markets, how the market orders and limit orders are getting interacted, how they are being filled. When I say how the orders are getting filled, orders mostly filled in the markets. Whenever a market order which is punched by the trader, it matches with the order book which is sitting in the exchange, right? So if you look into the order book will be something looking like this. This is a classical order book where you can see only up to 5 levels from your broker terminal, right? So which contains the ask price on the right hand side and the bid price on your left hand side. So these are the they're nothing but a limit orders. You can see that it's the book itself called as a limit order book, where only limit order book shows only passive players, where they put the limit price and they sit idle. They don't have any control in moving the markets. If at all, let's say the current market price is 11,489.75. If at all I want to move the markets by to the next level, I have to punch market order. Like I have to, as a buyer, I have to lift the offer or lift the ask price. So let's say I am punching one lot of Nifty. I will be moving the market by how many? 50 paise, right? 50 paise. That will be a 50 paise increment. Then the market price ticks up. So who has the real control over here? The one who punching the market order has the real control to push the market from 11,489.75 to 11,490.25. Right? So I'll be moving the market by 50 paise if I am going to punch only one lot. In order to punch the market by, let's say, another 50 points, or let's say another 25 paise, I have to punch not one lot. If I'm going to punch one lot, only I'm going to move the market by only by 50 paise. If I am going to punch, let's say, by 6, 12, let's say 18 lots, I'm going to punch 18 lots. I'll be pushing the market way down to 11,490.55. I'll be eating all those limit orders when I'm punching the market order of 18 lots. Then I'll be still further moving the markets by 11,490.55. Am I right or wrong? So who are having over here, they don't have any muscle power to move the market. It doesn't matter, let it reach 1,150 or let it reach 11,150. They doesn't has any control over the market. All their job is to just put the limit order and sit idle. And who is mostly having the control is only the aggressive buyers or the aggressive sellers. When I say aggressive buyer, I mean the one who is punching the market order. When I say aggressive seller, is the one who is punching the market sell order. So these levels are called as dome levels, depth of the markets, dome levels. It's called as a dome levels. Typically for Indian markets, we only get up to 5 levels. Whereas if you are trading in US markets, you may get up to 10 levels. most of the US markets, the ES mini or the crude oil, you'll be able to get up to 10 levels. Whereas if you are institutions, you may go up to 20 levels also. They have a complete control over the order book. They have complete visibility over the complete order book. Okay, now let's get back. So the order flow helps in explaining whether trade is executing at the ask price or the bid price. That's what order flow visualizes, and it shows you. It shows you in the form of a table. Let's say, take an example of a candlestick over here. Let's say here is a candlestick. So here is a candlestick. What it shows is that we can split this candlestick into price blocks. I'll say like I'm going to separate this into kind of a brick size, and that brick size is 1 point. Assume that each and every block is 1 point, and the order flow will separate this particular candle into 2 blocks. One is the buyer block, which is on the left hand side, and another one is the seller's block, which is on the the buyer block, which is on the right hand side, and seller block is on the left hand side. As the candle, as the auction kicks in, let's say this is a 5-minute candle, the 5-minute candle, or whatever let it be the candle. As the candle opens, the orders will be coming in. Let's say somebody is pushing the market by 1 lot. So at this price level, somebody pushes the market by 1 lot. So you will be seeing that at that rate, buyers would have been pushed the market. So buyers, it shows 1 lot. Okay, again, it moves higher. Maybe again, buyers would have been pushing the price further up. So again, let's say 5 lots are coming in. 5 lots, 5 buyers would have been pushed the market up. So they are pushing the market up by another one more point. And let's say again one more place where the buyers are coming and again pushing. Let's say another let's say 7 lots, right? And now as it reaches the top, now again sellers will be trying to take control. They will be pushing the price down by again 10 lots of sellers would be coming over there. Again, it comes down over there, let's say 7. And now buyers, again it pushes down, again, let's say 5. But again, price goes up. The buyers, some more, another additional 7 lots would have been punched. So already 1 lot is already punched at this level. So additional 7 will be added over here. So it becomes 8. So this level becomes 8 over here. As the auction keeps on going in up and down, up and down, up and down, every time it's revisiting a certain level, those levels will get appended with the new values, right? So it will be added to the old values, and finally you will be seeing a blocks of numbers where at times you'll be seeing 100 lots coming in as a buyer, and 50 lots over here, and 20 lots over here. Likewise, you'll be able to see numbers of buyers, total number of buyers at each and every price level, right? So at this level, you can see there are total 8 contracts got traded over here, and 100 contracts got traded over here by the buyers. It's mostly those orders are mostly from the market order buyers. When I say market order buyers, who is on the counterparty? The other counterparty is the market or limit order, who is sitting in the limit order book, right? So if somebody punches 100 market orders, 100 lots of market orders, then the counterparty, the equivalent counterparty, assume that this is the market order, MKT order, MKT. The counterparty, assume that this is a buyer. The counterparty is nothing but a seller who has a limit order, who already placed a limit order in the order book, limit order of 100 lots. So that is how each and every contract is matched. So every contract has a buyer and a seller. If you are seeing a 7 lots on the buying side, that means 7 lot is punched by the market order. They are the takers. They are the takers. Market orders are the takers, and the one who is providing liquidity, which is sitting on the order book, are the liquidity providers, right? So Maybe I can put it in a notepad. So punching market orders, we call them as liquidity takers. They are the takers. They are the one who actually pushing the markets up. And limit orders, sitting in order book. They are liquidity providers, right? They provide liquidity. At times, the limit order book can be filled by institutional quantity also, because most of the times, institutions, most of the times, when I say most of the time, we can say, like, you can have a rough number. 80% of the time, institutions play the liquidity game, and mostly they are the liquidity providers. And yes, at times 20% of the time they do aggressively participate in the markets, but they don't participate aggressively in the markets all the time. Otherwise, they are the one who will be moving the markets all the time. But the actual trending movements happens in the markets only 20% of the time, and remaining 80% of the time, market will be balancing. So there will be a lot of accumulation. Institutions love accumulation and distribution. So 80% of the time, they'll be not aggressively participating in the markets. They'll be participating mostly in the form of liquidity providers. So 20% of the time, they aggressively participate in the markets, right? So order flow shows only executed market orders. You cannot visualize where the limit order is all about. If you want to visualize limit orders, there is one more tool is there. It's called book map. It's called a book map, which shows where the liquidity is all about. You can also visit bookmap.com. There is one more tool. Now it is again one more evolving concept, but as of now, for Indian markets, it is not available because that requires minimum 10 levels of DOM. And as of now, most of the brokers provides only last 5 level DOM levels. So you might be seeing some thick levels over here. So whenever you're seeing thick levels here, there is a thick liquidity is pending. These are pending limit orders. These are pending limit orders sitting in the system. So where a good amount of liquidity is coming in. So this is where you will be able to see liquidity, where the liquidity is actually sitting at what price level, at what price level more buyers or sellers are. This is where you exactly will be able to visualize where most of the stop loss is there, where most of the, from the market profile, we can have a study that below that there is a stop loss is there. Here in order flow, in bookmap, you can actually visualize where the liquidity is actually hiding, right? So again, this is again an evolving study, but we are not going to focus now, because for Indian markets, as of now, there are no data providers available to supply this. eSignal provides, but that too they are providing only for cash markets. But for future markets, they are not at all providing. And similar tools are now started arising for not only bookmap. Bookmap started it, but similar tools are now developed by many Ninja Trader vendors or multi-chart vendors. So this is again one more a new evolving tool which has been in the study for the last 3-4 years or so, last 2-3 years or so. It's getting popular, but this requires a huge computer resource because a lot of data will be coming into it. It's not just bid and ask data. Along with that, many data also coming parallelly. The top 10 buyers, top 10 sellers, all those data will be flooding into your disk space. So a lot of computational power is required, and it's going to consume a lot of memory. Whereas order flow doesn't require much. It requires a decent computer power. This is the basics for bookmap. I would say that once you understand order flow, the next level is the bookmap. And till today, bookmap is mostly for scalpers. The order flow and bookmap are the tools. You can do scalping, or you can also time your trades. If you want to time your trades, now order flow will talk about at what price to execute it. It talks about at what trade location you have to go and play it so that your risk is very low. Whereas market profile talks about market profile or any other trading analysis studies, it talks about when to play, but only order flow is the tool which talks about where to play and at what price to play. That's what it talks about. It always talks about trade location. Only from your order book you can visualize the pending limit orders. I mean the top 5 bid and ask levels. Whereas the order flow shows executed market orders. So as I said, the counterparty is always the limit order. So what we can observe from order flow? Order flow, we can see at what price level the big orders are coming in. Maybe if you're looking into the candlestick, you will see which candle is having a big volume. Whereas if you look into the order flow, inside the big candle, I mean inside that big volume candle, at what price level exactly that big volume came in? Is it came in a distributed manner, or at only one price level that big buyer or big seller showed up? And you can also see where the momentum is getting built, whether the momentum is momentum players are the buyers or the sellers. You'll be able to visualize from the order flow how the liquidity flow is for the day, whether a big liquidity is seen, a medium liquidity is seen, or a small liquidity is seen, or a low liquidity is seen. Especially on even days, you'll be seeing a big flow of liquidity from big liquidity always talks about there's more participation happening in the markets in terms of volume. And when there are non-event days or when there are dull, boring days where the institutional activity is missing, you'll be seeing a dull, boring activity. Those days, the volume flow will be relatively less. So if you know what is the relative volume, you can be able to classify which is a big volume, which is a small volume, which is a medium volume. So you will be able to figure out how the liquidity flow is actually happening for that day. Right, and you can also spot where the momentum exhaustion is happening. There are a couple of momentum exhaustion setups, which is also part of your trading strategy here. And we'll also look into something like stop hunting, where the stop hunting happens, and how you can able to spot the stop hunt, whether this is a stop hunting or not. How you will be able to say that. I'm going to show you a couple of examples how to show how the stop hunting happens, and you can also see the trapped buyers and trapped sellers. At times, a big buyer or a big sellers will be coming and get trapped at the day high or a day low. What does that mean? How you can make use of that as a trading strategy? We're going to look into it. So when it comes to order flow blocks, there are total 5 blocks you have to think about. One is the bid and ask ladder. The orders are nothing but you can also call as a bid ask blocks. The second one is the commitment of trade and contract reversal. These are additional data points which supports what kind of sentiment is going on in the markets. What kind of sentiment is going on at each and every candle. And volume profile for the day. Volume profile for the day with a bid-ask histogram. There's one more table tracker which lists down for each and every candle what is the total ask. What is the total number of buyers, total number of sellers, what is the delta, what is the cumulative delta, what is the volume. The table which lists down is kind of a dashboard which provides you complete information about each and every candle. It lists down the total number of buyers, total number of sellers. Whereas if you look into the volume, or if you look into the candlestick studies, it shows only the volume. It doesn't bifurcate whether it's from the buyer volume or from the seller volume. Whereas here it actually classifies whether it's a buyer volume or a seller volume, and it does many relative studies related to that. It also gives you delta candles. Probably the order flow blocks looks like this. So you can see the order flow blocks over here with buyers and sellers. So the buyers on the right hand side, and sellers on the left hand side. Center there is a candle here, so that you can see the candle. It's a 5-minute chart, so 5-minute candlesticks. And here is the bid-ask ladder. It will be coming in the form of a ladder type. That's why it's called as a bid-ask ladder. And here the bottom is the dashboard, which tracks the total number of buyers, total number of sellers, the delta, minimum delta, maximum delta, cumulative delta, volume for that particular candle. You can track at each and every price levels. And you can also see the histogram. So you can see a histogram over here, which is nothing but the volume profile only for that particular day. So what is the volume profile talks about? Volume profile talks about at that price level. Let us assume that this price level. If I sum up all the number of buyers and the sellers, I'll be getting a value. Let's say at that price level, 3,094 contracts got traded. And out of that, 50% of the people are the buyers, and the remaining 50% are the sellers. That is histogram talks about. Histogram talks about at what percentage they are buyers or what percentage they are sellers. That you'll be able to visualize from it. So using the volume profile, you'll be able to know whether the day's volume is secured or not, whether the day's high is secured, whether the day's low is secured or not. And you can also visualize where the maximum volume is happening at the kind of a volume point of control. And there is a delta candle over here, which I'm going to talk about. Delta talks about who is in control in that candle. If the delta is positive, that means if you're seeing a big green candle, that means buyers are controlling there. If you're seeing something like a big red candle, so you can see something like a big red candle, that means sellers are actually controlling that particular price level. Sellers are in active control over there. If you're seeing a big negative delta, or we can say like a big red candle, that says that the more number of sellers are present in the markets compared to the buyers. Okay, to get a hang of it, I'm going to show you the replay of how the order flow looks like. Let me pull up. So I recorded one of the order flow examples here. So one of the day I had done a live recording of the order flow. No, not this one.
Hello, sir.
Yeah.
Jim Dalton in every half an hour will observe that value, NYSE value, I think. So here what we can in Indian market observe?
Volume or value?
Volume. Each half an hour candle means in profile, you will observe one value. NYSE, I think NYSE value.
NYSE volume.
Yeah. So here what we can observe in Indian markets?
See, that they are looking into NYSE volume to understand whether that volume is controlled by institutional day or not. If they are seeing bigger volume, they will say like that particular day's volume is controlled by institutions. Let's say the previous day low is broken out and you're seeing a big volume in the NYSE. NYSE in the sense he is looking into the cash market volume.
Okay.
Right. So if the cash market volume is really big, let's say compared to last 10 days, now they are seeing a bigger volume and market is breaking up. That means some institutional presence is there, some long-term player presence is there. To understand whether investors' presence is there or not, or long time frame players' presence is there or not. Only for that purpose, they are looking into the NYSE volume. Here also you can do the same thing. Here also you can look into the NSE cash turnover volume. where NSE has a separate page. So NSE turnover. So they have a separate page to check during real-time market hours. NSE India. Here. So this will be updated during live market hours, where you can record every 30 minutes and you can check whether it is an institutional volume or not. But then you have to come as a separate, you have to record it and then you have to observe it. So it's again one more time of screen time is involved. Rather than we can try to do the same study with order flow itself, where we are not looking into exchange volume. So we are not looking into any cash market volume over there. If you want to spot whether there is a longer time frame activity is there or not, yes, this could help. If the volume is getting relatively large, then some institutional presence is there in the equity markets. So that means that that particular day would have been controlled by the institutions. That some long time frame activity you can able to spot, not from the profile, but in terms of exchange volume, it will be able to show you. That's what he talks about. Then that's why he talks about NYSE volume there.
And sir, in order flow, in each and every half an hour candle, we get value in that bar statistics.
Yes, exactly.
So
but that will be Nifty futures volume. If you're looking into Nifty futures, you'll be looking into the only Nifty futures volume. So when institutions are coming and buying stocks, they'll be mostly buying stocks. That will be reflected in the Nifty is nothing but a derivative, right?
Okay.
So nothing but a buyers and sellers. Where and if I'm a long-term player, when I'm buying Maruti or ICICI Bank, I am indirectly influencing Nifty, right?
Okay, understood.
So, but if you want to spot the long-term activity, that is why they look into the exchange volume. Nifty futures, you may not able to get the volume because the long-term players will not actually come and participate in Nifty futures. They'll be coming and participating in the equity markets or equity derivatives, but that in turn indirectly reflects in Nifty futures. Yes, Nifty futures buyers sellers will be pushing the markets up and down in Nifty futures, but the institutional activity will be spotted only in the equity markets.
Okay. Thank you, sir.
Yeah. Okay, so I'm just trying to show an order flow charts. I'm not able to check. I'm not able to get some real examples I kept. Okay, anyways, better I'll try to simulate last Friday's activity. I think that will do better. What I'm going to do here is I'm going to close most of the charts. And I'm going to keep only Nifty future order flow charts. So here is Nifty futures order flow. I'm going to close rest everything. Okay, so here is the Nifty futures order flow charts. So now let's try to simulate what happened in the last Friday. So I have to go to control center and enable playback. Go to the control center, connections, enable playback connection. I guess this will work out. Friday, let's say play. I think the tick data replay has to be enabled. Yeah, it started. That's good. So you can see here, by default, the software control has, and if I go to the software control, if I right click, I go to indicators. There are two main settings I will be bothering about it. One is the lot size. The lot size is 75, where I key in the lot size, and I'll be getting in terms of lots only. So otherwise, if I put by default, the value will be 1. If I'm going to choose 1, I'll be getting the actual volume, not in terms of lot size. I'll be getting the actual volume over there. That's the default setup you'll be getting. And like the TPO size here, also we call that as a brick size or a price per row. So these numbers are really tough to read. So I don't want to read a 450. 450 doesn't mean anything. So rather than using the actual quantity got traded to visualize in terms of lot size, that will be even much better to read. So I'll divide by the levels by 75 and I'll apply it. So I'll be getting in terms of lot size, how many lots got traded at each and every price levels. I'll be able to know about it. So now whatever the levels I'll be getting is in terms of number of price level, number of lots level. This is a 5-minute chart. I'm going to run it on 5 times of the market speed. So, okay, 6 times of market speed, so that we get momentum. So in that particular 5-minute candle, so this is around 1040. Wherever the price is moving, you'll be getting an the price, as the price moves up and down, you'll be seeing that the volume gets appended to that previous volume, right? As long as it is keep on visiting the previous candle. I think in another 1 minute or so, it's going to change a new block. A new candle is about to form. Yeah, new candle forms. You can see how the auction is happening there. You can see the 22 lots got traded over here. So when the sellers push up, you would have been seeing a lot of zeros over here. So the sellers are pushing up, a new blocks form. The sellers are pushing it up, and new blocks are forming. Whenever the price is visiting a new zones in that particular 5-minute candle, new blocks get formed up. And you can see the numbers where the volume is getting traded most, which side. This is buying side, this is buying side, and this is selling side. Right, and there are different modes. By default, the default mode will be bid and ask mode, where you'll be seeing only a dark red. The red color blocks is where the sellers, and the green color blocks is where the buyers. You can see a lot many zeros over there. That means that zones are not traded at all. And thicker the red block is, if more the thicker it is, that means lighter volume got traded over here. If it is a less shaded block, right? So if it is a lighter shaded blocks, that means bigger volume traded over here. Usually, most of the order flow tools they use lighter shades for lower volume and bigger shades for higher volume. But the Ninja Trader background, if we are going to use the same thing it won't be right. That is why they done a reverse in Bell TPO case, where the thicker volume means it's low volume zones, and lighter shaded means it is high volume zones. The same applicable for on the buying side as well. More thicker the block is, that means low volume got traded over there. So this is bid and ask ladder, typical bid and ask ladder. And
So what is that CR value?
now I'm going to talk about it. Let me talk about it one by one.
Okay.
Next comes the bid and ask ladder is just an experimental thing. Don't look into it as of now. It doesn't has any meaning to it. We asked them to remove it. Next comes the bid ask imbalance. The bid ask imbalance is the one which I prefer to use during live market hours because it is what it talks about the momentum, right? So when I am comparing the price, we'll be comparing price diagonally. Mostly we'll be comparing price diagonally. So wherever the price is more than 10 times compared to the selling side, the buying side volume is 10 times. It plots a dark green color block over there. And likewise, when we are comparing to the buying volume with the selling volume is 10 times more, then we get a block over there. So just to visualize where the momentum is getting developed, right? So where we compare the prices only diagonally over here. We have to compare diagonally because the bid ask price are never equal. Let's say if the buyers are at 100, then the sellers will be, I mean, if the sellers are at 100, then the buyers will be at 99.5 at any given level. So we have to compare diagonally. Because the bid and ask price will never be at the same price levels. These colored blocks will get settled once the candlestick is completed. So if it is 5-minute candlesticks, so once the 5-minute candlestick is complete, then only you'll see that where the momentum is getting developed. In a live running candle, you cannot see the momentum comes and all of a sudden the momentum could disappear. So always it's good to read once the candle is complete, then you go and read the momentum. So now you can see that the volume is getting increased over here, means the sellers are actively trying to put more orders at that particular price levels. So it's initiated by the sellers. So as the price goes down, you can see the sellers are trying to push the market down and the selling quantity is getting increased over there. Right, so here is the candle. And inside the candle, we are looking into it and we are saying like, hey, at this level, the volume is more in that candle. That is controlled by the sellers. That kind of microscopic view, it's get you. And the below table, it sums up a couple of data points. Like one of the thing it sums up is the total number of buyers and total number of sellers. So you can see in the ask table, which is nothing but the buyers, total number of buyers. If I sum up all the buyers in this candle, right, what I'll be getting is total number 188 lots got traded. So this is 188, which you can see from the ask table. There is ask table over there. And if you sum up all the sellers volume, then what you'll be getting is a 310. So 310. That means in this particular candle, that's a red candle, there are more sellers. The seller quantity is 310 and the buyer quantity is 188 lots. So the total volume got traded is 398 lots in total. That is the total volume this talks about. Of course, the volume is not visible, but that is the volume section. Now you can see one big lot got traded over here. 640 lots got traded over there. Right, so 640 lots means some kind of a big buyer entered at that price level. We're not sure whether they are smart or not, but some big buyer entered at that particular price level. I mean, big seller entered at that price level. So who is the counterparty? The counterparty is someone sitting on the limit order book. And the price ticks up again. See, the price is going up with low volume, where a seller is present here with a big volume here. Yeah, the buying, the auction is pushing the price up. Even that there is a big selling quantity. Despite that, with low volume, the buyers are able to drive the price up. And again, so is this guy smart or not? We don't know. What we don't know is whether he is smart. We don't know how much, whether this is an entry order or exit order. We don't know. Whether this is a stop loss, we don't know, right? So we also don't know how long he's going to hold. If this is an entry order, if he's placing an 662 lots of selling order, he's willing to short, or it is a old position. We don't know whether he is going to cover in next 5 minutes or next 10 minutes. We don't know whether he is going to hold for next 1 year. We don't have any idea about it, right? But there are certain auction behavior we can able to justify. We are not bothered about who he is. We are not bothered about who he is. We are not bothered about whether he is smart or not. We are not bothered about whether this is entry volume or exit volume. We only know that this is an aggressive selling volume, right? So aggressive selling volume came at this price level. That is one information. But there are times you might see a stack of selling volume. Like you will be seeing a stack of red color bars. Maybe I'll show you once it's going to appear. We call that a stacked imbalance momentum zones. So I want to speed up the auction a little bit further. I'm going to pass for time being. You can see there are zones which is not got traded at all. If you look into these zones, all these zones are getting traded. So all those zones got traded over here. All the price levels got traded over here. And you will be observing that, you see that the 0 and 0, you'll be observing in most of the candles, the 0 on the left hand side and the 0 on the right hand side. 0 on the left hand side, 0 on the right hand side. Right? So, but there are cases you won't see at all. See, in this case, there is no 0 at all. There is no 0 at all. But here is a 0. Because we compare only price diagonally. When we compare price diagonally, compare price diagonally. So we don't compare this price and this price. We don't even compare because it doesn't exist. But at times it could come. You could see in order flow. You could see in order flow that 34 kind of levels that we call as an unfinished business or unfinished auction. That level will get revisited. That level could revisit. At times it gives you only small opportunity, but at times market falls down some 30, 40 points from there, but eventually it revisits those levels. So we call that as an unfinished auction. Unfinished auction. They are poorly visited auction. They are mostly poorly visited auction. At times, an unfinished auction, these kinds of levels can happen, and then price drops. It gives 30, 40 points opportunity or 50, 60 point opportunity at times. And then it revisits back to whatever that level has the odds of revisiting mostly intraday. And in a very worst case, it may not get clear because those auctions will be get formed around 2:30 during intraday or 3 o'clock intraday. So those auctions get revisited by next day. Right, so mostly it gets revisited by next day. So unfinished auctions are one part of the trading strategy. One of the trading strategy we will be discussing is the unfinished auction. They are nothing but the poorly completed auction. A good auction will be completing like this. That's a good auction. At each and every candle you'll be seeing the 0 and 0 at the diagonals. One on the 0 on the top left hand side on the selling side, and another 0 on the top right hand side. A poorly completed auction, either you will be seeing a 34 over, you will be seeing some numbers either here, or you might be seeing some numbers over here. Those are the levels which are most likely to be revisited because they are poorly facilitated auctions, right? And you can see it on any time frame. You might see it on a 5-minute charts or a 3-minute charts, and it's not a regular thing. But when it is happening, you should recognize that it's something that you have to give your all your ears to. We see this numbers only on a completed candle. On a non-completion candle, we don't look into it, but only if the candle completes and you're seeing a number at the top left or the bottom right corner, then only we'll consider that as a unfinished business. Or you can say like an UB or an unfinished business. People call that as an unfinished business. They call it as an unfinished auction, right? So they are mostly non-complete auction. Price will again revisit to complete the auction there. Okay, I'm starting the auction again. And you might be seeing a red block over here, the red followed by a box. That is nothing but only this block, the total volume is more. It's kind of a volume point of control for that particular 5-minute candle, where the volume is most. So that is what the red block it talks about. Again, it's kind of a visualization. Nothing we are going to make use of it, but it's kind of a volume point of control for each and every bar. And typically, if you the other things what we'll be noticing is over there. Okay, now you can see something interesting is happening over here. I'm going to pass this. I'm going to show you when this candle is breaking out. You see that I'm going to elongate this candle. This is the current candle which is running in. All in a sudden, the candle. What happened was that the candle was dripping down and dripping down and down. You can see there are more sellers are coming and participating. More sellers are participating. You can see that is what we call that as a stacked sellers. Stacked sellers are nothing but when comparing diagonally, minimum we need 3 blocks with decent volume where they are completely only sellers in that volume. That is why we say like a momentum is getting developed. So that is why we can spot out that auction imbalance is getting developed, or we can say like momentum sellers are stepping in and they are pushing the market really hard. And when they are really pushing the hard and the price reaches the day level, this is the previous day's low. This is exactly previous day's low, 10,835 levels. When the sellers are pushing down below the previous day low and they're pushing really hard, that is why you are seeing a lot of red color blocks over here below the previous day low. So assume that this is draw a reference level and say that this is previous day low. When they are pushing it hard, you're seeing a lot of zeros over there. That means those are no liquidity zones. Those are no liquidity zones means in the limit order book, there are no sellers exist at those levels. Almost for 10 points, there are no liquidity available over there. The next liquidity, the next limit order is available at these levels only, either at these levels or on these levels. The sellers are pushing it down. So the next buyer, the limit order buyer is over here. So let us assume that the limit order buyer is 17, right? So this is a limit order buyer which is going to taken by the market order sellers. When the market order sellers are going to eat those 17 limit order buyers, that is why you're seeing a 17 over here, right? So that means in the order book, if you see, there are no buyers existing in this band. So there are no buyers in the limit order book. The next buyer in the limit order book is 17. And that has been eaten up by the market sell orders. Market sell orders are flooding into the markets. People are continuously punching aggressive sell orders. And then they are pushing it down below day low. And again, more market orders are flooding in. So the next available buyer is sitting in the order book at 10,826. That means it could be in the form of a day low. When the day low is approaching, the people most of the people have a behavior to place their stop loss below day low. So they don't place exactly at the day low. Probably they'll be saying like day low plus 5 points, day low plus 10 points. That is the level they'll be mostly placing their stop loss. So that is why most of the orders are not below day low, but some 10 points below day low, there is a lot of liquidity over there. And those liquidity, if you are trying to visualize those liquidity, maybe I'll show you the book map, how the book map looks like. And so that you can get a fair idea about how the pending limit orders will be present in the market. Maybe I'll show you the book map example. Okay, here it is. Maybe I'll run this book map overview.
Significant technical performance improvements. Let's take a closer look. In Bookmap 7, Bookmap 7.0 has many new and powerful features that promise to deliver unparalleled clarity and transparency in market visualization. Let's take a closer look. In Bookmap 7.0, you will immediately notice the new colored heat map. You'll see the options available from the main toolbar here. Click on the drop-down and choose the option you prefer. You can choose the older grayscale heat map if you like, or one of the new colored options. Let's select the middle option here. In this colored heat map, starting from the left, areas of low liquidity are dark gray. As we move right, areas of blue are higher liquidity. Higher still are the white areas and then yellow areas. The orange areas display the highest levels of liquidity.
Okay, I'm going to pause the video over here. So the price is moving like this. The price is moving like this. And you can see many pending orders are here. So these are pending orders from the order book. The more darker it is getting, more number of volume is sitting over there, bigger volume is sitting over there, right? So more, the blue lines are where the low liquidity is there. They might be simple order book. If more and more darker it gets, it could be in the form of a stop loss, or it could be an iceberg order, or it could be some institutional limit order to put a ceiling there. So, or if you're finding that it's coming, those kinds of thick limit orders, which is coming below day low, you can see there are no liquidity zones over here. That is why when the price drops, in the order flow, you'll be seeing that next level, it gets this thick block of limit orders. You'll be getting, and then next liquidity zones are available over here. And you can see some gaps in liquidity. There are no orders, there are no pending orders over there. And next liquidity is available over here. Next sticker liquidity is available over here. So liquidity will be coming in terms of layers. There are price zones where there won't be liquidity at all. That is why maybe this could be a stop loss order. These could be a stop loss orders. These could be stop loss orders where most of the people put at the same place. People have a tendency to put stop loss orders at the previous day low, previous day high, 2-day low, 2-day high. Right? That is where when it is hitting the liquidity and it comes with a gap up, and all of a sudden you'll be seeing a lot of zeros in your order flow charts. Right? So this bookmap tool visualizes the limit order, whereas the order flow tool, which we are discussing right now, it visualizes only market orders. But you can visualize where the liquidity is there, where the pending orders are there. So based upon, okay,
Colored heat map is a great improvement.
I'm gonna close this. I'll get back to the charts. So when you're seeing a lot of zeros coming in, that means there are no liquidity in those zones. The next layer of liquidity is available over here. So price immediately jumps from here to here to take the liquidity, right? So who is taking the liquidity? The market orders are taking the liquidity. Market orders are always the liquidity takers. That's what I said over here. The market orders, who are punching the market orders are they are liquidity takers. But who are punching limit orders, they are liquidity providers. They are supplying liquidity to the market orders. Any questions?
Ajendran, one question here, like 2000 orders were been in the market profile tool.
Yes.
There are 2,881 sell orders, right?
Yes, exactly.
And they were buyers, and it was been brought from the buyers.
Yeah, because the next liquidity is available here. Maybe more stop loss would have been placed by the sellers over the buyers over here. the buyers would have been kept their stops over here. That is why, or we can say like once the price has been triggered, once the day low is getting triggered. So there are two things can happen over here. One is stops would have been hunted over here. These are the stops of the buyers. If already, let's say if I already I'm a buyer, if I'm a buyer, let's say there are a lot of buyers there who bought in the morning or who bought yesterday, and they used yesterday's low as a stop loss, yesterday's low, previous day low as a stop loss, previous day as a stop loss. Once I'm a buyer, I already bought. Now next I'm going to be a seller, right? So I'll be placing a stop loss. Let's say I placed a lot of stop loss. Not only me, the bunch of traders who already bought already, but they kept stops below previous day low, right? So they would have been kept a limit order selling. When the price is plunging down below previous day low, there'll be a liquidity gap over there. It jumps and takes the next liquidity. So in that case, what happens is that all the limit order selling activity, all the limit order selling activity will be absorbed by the market buy order. Maybe they might be placed the SL market order also. Some people would have been placed the SL market order also. That is why when the price comes down, it triggers a massive stop loss in terms of selling side. It triggers a lot of stop loss on the selling side. So if it is a stop loss market order, if it is an intraday stop loss market order, it triggers liquidity. When the price reaches a certain level, it triggers all the orders. So even this could be a stop loss order. Or when the day low broken, when the day low is breaking, it could invite more fresh sellers to, because they might be watching the price to break the day low. That could invite fresh entries, fresh selling orders to come in. So overall, it is nothing but an stop loss limit order. Maybe it also inviting fresh market order sellers to come and participate.
So in that case, Rajendran, what we have to see is there should be zeros, should be more, right? If the market is really going down, then there should be zeros more, right? In that case.
So these zeros are a result of a kind of a stop hunting, right? So these zeros are nothing but a result of a stop hunting. So that is why we call it as an liquidity zones. We call that as an exhaustion low. When this low is broken with a stop loss, it's kind of a stop loss hunting happened. That is why you're seeing a lot of zeros there. Means there are no trades happen in this band. There are no trades happen in this entire band. And those zones often revisits intraday. Those zones always market move from low liquidity zones to high liquidity zones, and from high liquidity zones to low liquidity zones again. They're nothing but a kind of an intraday gap. Means price haven't got traded at this price location at all. It's kind of an intraday gap. Those intraday gaps often gets filled. When you're seeing I'm not talking about only 1 zeros or 2 zeros over here. So we're not bothered about whether this zeros over here are getting filled or not. We're not bothered about it. What we are bothered about is the zero liquidity zones. I mean, I call that as a zero liquidity zones, where neither the buyers got traded over there, none of the sellers also got traded over there. Those are the zones, are the clear gap. It's a clear intraday gap inside the candle. So if I draw a daily candle and I'll say like volume happened in this band, all in a sudden you can see an intraday gap down. So again, volume happens over here. So these are the intraday zones where the price was coming down and next trade was happening like this. Those gaps usually gets cleared. So when you're seeing this kind of break, don't try to participate. Even if you want to sell, first let it come and clear, and then you initiate your sell from there. Right? So that's how it should be, because most of these zones, price have a tendency to revisit back. That is how the auction behavior happens. It is happening and it will happen.
Thank you.
Yeah.
Rajendra, one question. The 11:15 candle, you see 662 sell.
11:15 candle. Yes, 662 sell.
Right. So, and though there was a sell on the, I mean, that's a good volume.
Yeah, that's a good volume. That's a good volume. We never know, but they're smart or not, we never know. But if you ask me, on a 5-minute charts, usually the 600 volume, 1,000 volume are quite very rare on a day-to-day basis. 1,000 volume, which is occurring at that price level, right? So, which is very rare. A 600 is a decent volume. If you compare in that particular candle, 600 is quite a bigger volume if it is occurring only at that price level. And similarly, the 2000, which is also, it's not a very frequent one, which is a bigger volume. Yes, that means that aggressiveness is there. The sellers are aggressively participating throughout the day. We are not looking into one information over here, but throughout the day, if you look into this, so far the sellers are doing a good job over there, right? And at the same time, they're also triggering the liquidity. They are pushing the price down below day low. When they are pushing the price down below the day low, the liquidity next available, they are moving to the next available liquidity zones, and they are trying to do the auction over there. That is why even if the price moves down, price have a tendency to revisit those zero liquidity zones. These zero liquidity zones are often going to get cleared. So you don't need to be in a hurry to short when you're seeing this kind of information. That is why I want to take a neutral view. I never shorted this particular day, even though the sellers are pushing the market down. I don't want to short this markets because price, I was monitoring it, and maybe I'll show you the video where I started taking it. After that, I lost patience, and then I went to my office. I think I started recording this activity. Not this one. It's 11th, right? Oh, this is 11th. Oh, this is last year. I kept. Order flow examples. Okay, anyways, I started recording, but I missed it. Okay, anyways, still we have a live thing which is running on over here. You can learn from here itself.
The question was, Rajendra, even though there was a 662 volume, but the market still went up.
Yeah, the market still went up at that price because it is not only aggressive buyers coming at that markets, right? At any given time, you're going to see at any given time, I'm talking about at that particular instant, at any given instant, there will be aggressive buy orders also coming, aggressive sell orders also going to come at the same time. Aggressive sellers will be also present, aggressive buyers also present. So market orders will be coming at both the sides. But market will move in a direction which side they are more aggressive, right? That is where the side the market moves. What happened in this case is that you said like 662 sellers move the market, right? So why the markets haven't broken at that level? That is your question, right? At that instant, seller, so one selling order came, but then that's it. The sell order, the aggressive sellers vanished. Now the markets is in control in a very shorter period. The markets is in control of the aggressive buyers. They showed up, and that's it. Let's say I'm punching 1,000 lots of sell orders. I punched it. After that, what? After that, if there are no further sellers behind me and only aggressive buyers are coming into the markets, they are going to take the market up. Let's say once I punch 1,000 sell orders, 1,000 lots of sell orders, if the market has to follow the price, right, more sell order has to come into the markets, and a flood of sell orders has to come into the markets. Then only market could go down. That is how the liquidation takes place. How liquidation takes place? Once I placed a sell order, there will be a sequence of sell orders. Somebody will be placing sell order again. Somebody will be placing sell order again. Somebody will be, now that will trigger a lot of massive sell orders. That is why you see a strong liquidation, strong cut in the markets. It is not because of one guy selling the markets. They don't have the potential to bring the market down. It is a sequence of market orders coming in, which is going to be a market sell orders, which is what is exactly happening over here. A sell order came, and again a bigger sell order came, again a bigger sell order came, again a big sell order came. Then it triggers a massive liquidity. Again, that creates a more trigger, and that brings the market down, comes down further, and more big sellers are coming and participating there. More aggressive sellers are coming and participating over here. That is how the momentum selling happens in the markets. Whereas here, momentum happens only at one trade location, but not at each and every price level. That is why when 662 comes, and then further there are no continuation of sellers in that particular candle. That's why even with the low volume, the buyers are able to take the price up. That answers your question?
So Rajendra, if even but for instead of 600, if say there is 5,000 lots,
yes,
on a single price, on the single price,
price can go up. Price can go up still, even if there is 5,000 lots. Yeah, still okay. Price can go up because there are no follow-through sellers. When there is the lack of follow-through sellers, market usually goes up.
Okay.
Right. So, but you never know how the market order. Nobody can visualize unless the market order hits the exchange. So only if you hit the exchange, you can visualize it in the form of an order flow. Because how do I know whether Rakesh Jhunjhunwala is going to punch now or not? Once he is going to punch, then only we will be able to visualize it. You can visualize limit orders in the form of bookmap. You can visualize market orders in the form of order flow. But the future market orders, nobody can visualize it. Right?
Yeah.
Yeah, but if the price has to go down, we need aggressive sellers to come and participate. It's not just one sellers, or at times institutions. Let's say I'm an institution and I want to offload 1 lakh of Reliance shares today. So I'll be sending in packets, 10 lots, 10 lots, 10 lots. I'll be sending at each and every 5 seconds interval. I'll be punching 10 lots, 10 lots. Maybe I'll be hitting the market orders. I want to offload in next 3-4 days. So I'll be punching in a packet size, right? So maybe one big guy, he don't want to punch in one shot. What they'll be doing is they'll be coming in tranches. They'll be coming in packet size. So they'll be punching 100 shares, 25 shares, 35 shares. They might have an algorithm to do that. They might be
in a different prices.
Yeah, at different prices. There are algorithms are there, right? They'll be using volume weighted average price as an algorithm, TWAP as an algorithm, or they'll be using iceberg orders as an algorithm. So if you look into Nest, they have some closely 10 to 12 algorithms to bifurcate into packet size and selling into the markets. There are algorithms which comes only in the first half an hour and last half an hour. Those algorithms will participate. Some algorithms will participate when there is a big liquidity is there. Some algorithms will spread across the day equally. Some algorithms will spread across based upon the VWAP levels. It spread accordingly. Some algorithms will spread based upon TWAP. It spreads based upon what kind of algorithms the institution want to use. So each and every algorithms are designed to reduce the cost of the institutional investors. So that you don't see, they don't impact the markets all the time. They don't keep impacting the markets all the time. They might be present in the markets, but they will be hiding in the form of an packet size. They'll be sending in packet size, so they don't have greater impact in the markets. They'll be eating the liquidity, or they'll be selling it to the counterparty in tranches mostly. Not every big order are institutions. But when the institutions are present, maybe you'll be seeing a momentum selling, and momentum selling, and momentum selling. That kind of momentum selling you might see with a bigger volume flow. So you'll be seeing like 1,500 sell orders in one of the candle. It's a 1,500 sellers. Again, next candle, again you find 1,600 sellers or 1,700 sellers. Big sellers will be coming in, and throughout the day you will see a pattern of a big order flow coming in, 1,000, 2,000, 1,500. So those kinds of big order volume which is coming in on that particular day all are positioned on a one-sided. Then you know that some institutionals are really aggressive in pushing the market down. Otherwise, it doesn't happen frequently. It usually happens on event days, news-based events. It happens. You can find that kind of one-sided institutional presence. Right. So what I'm going to do is I'm going to continue further to check how the auction behaved for the day. I'm going to replay again, 10x market speed. So again, sellers are pushing the market down. Again, you see there is one more stop hunting happened. You can see a lot of zeros over there. Usually, it usually gets filled faster. So a lot of zeros was there, but now the auction is coming, moving up and down, up and down. It clears it. Okay. So here the market is falling because lack of liquidity, and next available liquidity, it's keep on taking it. That is why the market fallen there, because of low liquidity zones. They are local liquidity zones, so price is able to travel faster down. But at the same time, those liquid zones are meant to be cleared. It's kind of an intraday gaps. It's mostly gets revisited faster. And again, you can see the pattern again here. These are good auctions. The zero which is coming over here, and the zeros which is coming on the live. You can see the same pattern which is there everywhere. That is a good auction. Okay, now see the sellers are no more in control. They flood of sell orders came. Now maybe you can see one more big quantity got traded over here. One more big quantity got traded over here. Right, and there are one more pattern you can see that. You can see this particular day. It's kind of a double bottom. It's kind of a double bottom. 33, 35 lots got traded over here. Again, 34 lots got traded over here. At times, it can become one more level also comes over here, kind of a triple bottom. These are weaker lows. Usually, stops will be present over there. Let's say the price comes down. Again, it comes exactly to the day low. Again, buyers are initiating. Again, those are the buyers are mostly intraday buyers. Again, it's kind of a weaker low. Price have a tendency to revisit back, because at the same price, this is a day low. This is day's low. Low volume came in. Again, price went up. Again, exactly come to the same day low. Again, buyers are initiating trades over there. That is how the intraday players behave. So they are they're waiting for the price to come to the day low. Again, they're initiating trades over there. They are mostly trading money again. Now again, you could see that price would have been comes and touches exactly to the same level. Maybe I draw a line over there. You can see how the players behave very mechanically over there. So this is where some mechanical levels got spotted already. Okay, one more stop would have been hunted down there. Again, you can see one more big sellers coming in. So a lot of zero zones, which is most likely to get filled. It got filled. But a zero over here, it can remain. Something like a couple of zeros over here, it can remain. That is fine.
No, sir, are you moving your cursor? We are not able to see your screen.
Okay, maybe now you should be able to see the cursor. Because I was drawing, I am using a drawing cursor over there, so I may not be able to get it. Right, so 3 times liquidity trigger got happened. Right, so 3 times liquidity trigger got happened. So what I want to say is that this is where the intraday players try to initiate trades over there. The price is reaching a day low, and the price bounce back. And again, price comes in and touches exactly. Somebody is waiting for that day low to initiate a trade. That is most likely a stop would have been placed over there. So scalpers play like that. Mostly scalpers play like that. So they would exit their positions. Whatever the positions they accumulated, they would have been exiting. Maybe the one who is exiting here could be the scalpers.
Still, we are unable to see the cursor.
Again, I think your screen got stuck.
Okay, maybe I'll pause it and then let me explain. So when the price reaches day low, right? So it reaches a day low.
No.
You're not able to see my cursor?
No.
There is a crossbar is there.
No.
The screen is frozen.
Screen is frozen?
Yeah.
Oh, okay, I'm sorry. And now you should be able to see that?
Yes.
Okay, maybe I think somehow the screen got passed. Okay. Anyways, what I want to show here is that it reaches a day low. It reaches day low. You see that the level 35 here. I draw a line also over there. So maybe what I can do is that I could replay, go a little bit back. Maybe I'll go to, there is a go to bar available. So you can use right click and go to. So I can move to some, let's say I want to move to 1140. I'll replay the data again. I'll go back to 1140 and show you how the activity happened over there.
Is this available for everybody, the playback?
Yeah, it's available for everybody.
Okay. Do you need to enable something on the indicator or the data side?
No, nothing. So it's adjusting the data to 1140. So let's just wait for some more time. Okay, it's 1140 almost, and it's going to stop at 1140 exactly. Yeah. So when the liquidity trigger happened and price went on testing day low, right? So you see the volume was 35 over here. That is the day low for the day. That is the day low for the day. Now I'm going to continue the auction here. Right? You could see that when the price is approaching the day low again, so price was approaching day low. Exactly, the buyers are pushing the price again from there. Most likely, the scalpers might be pushing the price from there. The scalpers might be pushing the price there, so they might be started adding more position to that, and exactly they used to have a stop below that. At times what happens, this could happen 3 times in a row or 4 times in a row where stops would have been placed by them. So they don't give a commitment. If you think scalpers, they don't give a commitment. When price goes down below their level, they simply liquidate. They might be moving the markets. So maybe those locations are mostly dominated by the intraday players. That is why you can see that kind of mechanical over there, kind of a double bottom, which is happening over here. It's kind of a double bottom, which has happened over there. At the day low, if you are seeing this kind of double bottom, it is not a secure low at all. First of all, this is one more rule you have to keep it in your memory. Whenever a big volume which is happening at the day low, or a big high, let's say this volume is let's say 1,000 or 1,500 or something like a 300 lots which is happening at the day low, they are not secure low at all. So we keep saying that low is not secure. It can be broken. Even here, you see that the volume was very low at the day's low. Let me pass here. The day's low volume was only 69 lots. The day's low was only 69 lots. But if you look into the behavior, price went down. It tested a day low, and again buyers take control. And price again went exactly to the same low, and it is bouncing back because so whoever traded over here, they are mostly trading money. Whoever participated in this zone at the day low are trading money. And they most likely they could be scalpers. They might be looking for 10 points to 15 points. When they made the money, they will get out of it, or they will exit their position if the price is going to break. If the position is coming to break, if the position is going to against going against them, they are the first one to liquidate because they will usually tend to have a tighter stop loss. When they are looking for a 10 points, 15 points gain, their stop loss will be 2 points or 3 points from there. So when it is breaking down, you'll be seeing a big liquidity coming in again. Then that might be mostly they are the one who is stepping away from the markets. So let me continue the auction over here. I draw a line also to indicate that this level is mostly driven by some sort of an intraday players. See how when the price is approaching, just check it out how again sequence of sellers are coming in. When they are about to break, if you're seeing a big liquidity there, then you see that the stops would have been get hunted. So that is why you see that again you can see a lot of zeros over here, which is going to get filled faster because that is a zero liquidity zone. It gets filled faster. Usually that's what market does. And you see a big quantity over there. That could be a stop loss placed by the players who entered over here. When the price is coming down, they are the very first one to liquidate over there. So these kinds of patterns, you'll be able to cross correlate who would have been done that and why they would have been done, why they are doing here. So maybe this could be an exit order who already entered over here. The scalpers entered over here. They might be taking an exit because their stops would have been hunted. They would have a stop loss of 2 to 3 points. They can have when they are looking for a 15 points gain, they might be having a stop loss around 2 to 4 points. And that is the usual stop scalpers usually do. They'll be mostly looking for a very tight stops. And again, you can see a block of buyers are coming over here. Block of buyers. If you're seeing that end of the candle, that means momentum buyers are entering at that price level.
Rajendran.
Yeah.
Sir, where is our edge? Where is our opportunity in this whole, market action?
The whole market action is that the only thing is that short is still risky because there is one more liquidity zone is still about to get cleared. This trance is right. This zone is one of the zone you have to watch out there. This usually gets clear and it, in fact around 2:45 or 3 o'clock price went about 10,840 to clear that reference before again falling down. So without that blindly going short shorting this kind of markets because yesterday low has been broken and you are seeing big sellers, it's not a good setup at all. So I'm showing this only to understand how the auction happens and what you can try to. So still we haven't touched the basics of order flow, but just to show how the orders are coming in, how the big orders are coming in. We are not talking any strategies over here as of now, but just to observe how the orders are coming, okay. How the last Friday orders came in.
Okay.
Let me kick faster here. Let me increase the auction speed to 20x. So this is we are watching 20 times speed means every second 20 seconds of market activity is moving now. I'm going to remove this reference level. And you can see wherever the delta is bigger candle, you can see that is where more number of sellers entered compared to more number of buyers. So maybe I could increase the speed further to 50x. Okay, when you are seeing this quantity at day low, 429, so these are very bigger quantity in terms of Nifty. So if it is occurring exactly at the day low, then that day low is not secure at all. So probably if it is less than 200, something we can say like that day low or day high is secured. But if it is coming something like a 429 or 900 lots at the day low, 600 lots at the day low, they are unsecured zones where the price could be again revisiting to clear the day's low to complete the auction again.
This is again 101 and 170.
Yeah, 170 is fine, but it's something like a 400 is not unacceptable. 400, 600, 700, those kinds of things which is coming at the day's low, they are unsecured low. Maybe from there we can expect a short-term bounce, but usually those kind of lows gets cleared. A good low at the day's low, you'll be having a very less volume. Again, you can see here the day's low volume is pretty closer to 1828 volume. Now one more break taken. I think this time you can see 153. This could be a very less volume. That can be a day's low. That can be a day's low because less than 200, yes, it could be. But something like an 500, 600, if it is coming at the day's low, it cannot be a secure low at all. Now later on, momentum sellers are pushing the market up. Another 1 hour of market activity is left. Now the time is almost 2:30 plus. So lately the buyers are showing up, not big volume, but momentum buyers. You can see a stack of buyers coming in this location. So that's what we call them as a stacked momentum buyers. That shows the presence of momentum players. That auction, that zone is an important auction zone. When you're seeing that stack of 4 buyers or 5 buyers coming in a row, that levels will usually act like a support zone. I mean, from a scalping opportunity, that zones are very crucial. Anyways, we'll be talking about those locations, how you can use that as a support zones for scalping. So now these places, when the price moves up, you can again find a lot of zero liquidities over there. Again, usually price and come back and clear those reference levels, which is also cleared the old levels, the old auction levels where the liquidity trigger happened. The old liquidity trigger happened over here with a lot of zeros. The liquidity trigger which happened over there. That price revisit happened on the same day itself. That price revisit happened on the same day itself. So this is what happens most of the day. That means the intraday gap got a fill over there. When it is filling also, it creates a lot of zeros. It fills with a lot of zeros. Again, those zeros also got a clear. So I'm going to stop the session here and we'll take a small break and then we'll take a couple of questions. And again, we'll start with the basic building blocks of order flow. We'll try to get more insights about the basics first before getting into moving on to the basic trading strategies. Okay, let's start with the session here. So we looked into the limit order. The limit order book, they are nothing but passive order. Who are active orders are only the market orders, right? That's what we learned into it. Active orders move the markets. Market orders move the markets. Limit order, they don't have any control over the markets. The limit orders are just simply resting limit orders. They're just waiting for the fill to happen. They're just waiting for the markets. They are just waiting for the market orders to come. And first let's look into what is the intention of the aggressive buyer or aggressive seller. So who are these aggressive buyers? Who are these aggressive sellers? So they're the one, and when I say aggressive buyer, they are the one. They're the kind of a greedy people. Let's say the price moves fast, but they don't want to miss the price. They are fearful people also, because the price is moving against their position, so they don't want to. They don't want to miss the price. They want to take an exit because price is really moving fast against them. So they are the one who places market order to enter, because the price is moving really fast, so they don't want to miss the train. So they come and punch market orders. When the price moves against their position really fast, again, people places market order to exit their position. That is where, again, market order comes in. There are certain people places limit order, so to enter. So because they want to get the price at a particular price, they could be it's mostly an entry order. When it comes to exit orders, it could be a target order. So they want to exit at a particular price to exit, or they want to take an exit at a certain price level when there is a certain threshold is reached against their position. So it could be a stop loss order or a target order. They generally tend to exit at those locations. And some people want to hedge it, and some people, for some other people, it could be a pair trade. So the reason, the intention could be of multiple conditions. Mostly the fear and the greed drives the market orders. And when it comes to limit orders, it is mostly target orders or a stop loss order for an exit. And at times, if some people, they want to come and buy at a particular price. When the price reaches a certain price level, they want to come and buy. So they usually place us market limit orders over there. Mostly institutions place limit orders most of the time when it is thickly liquid markets. Let's take an example here. Let's say an institution, for example, let's say JP Morgan. JP Morgan is an institution, and they have clients under them, so who want to purchase some X quantity of Nifty futures for the day. So what they do is that when the price opens, when the market itself not having any liquidity, so they are the one who will be punching the market orders until they find the liquidity. So they'll be punching market orders. So they are the one who in the markets. They are the one who will be moving the markets initially. Once they reach the liquidity zones, they will be started putting limit orders. There'll be all these orders from the JP Morgan will be limit orders. And once all the limit orders got over for the day, again, to find the next liquidity zone, they punch the market order. They'll be moving the markets up. So they'll be using market order initially to find the liquidity. Once they find the liquidity there, where maybe here they might require only 1,000 contracts, or let's say 10,000 contracts to. They might require only 10,000 contracts to find the liquidity zones. In these liquidity zones, they might be able to get more. Maybe 30,000 lots they would have been able to get for the day. 30,000 lots in terms of limit orders. They would have been flooded 30,000 limit orders, where they're able to find the sellers who come and participate at that trade location, because they want counterparty to come and participate. And then again, once the liquidity is over, again they might go up to find the next zone of liquidity, next zone of thick liquidity, where they can get more sellers to arrive there, right? So again, they might be again another 10,000 lots over here. They might use it to push through the liquidity to find the liquidity zone where more number of sellers are interested, and markets. So those are the zones where you can find whenever you're seeing a thick liquidity zones, market usually goes sideways, right? So that means that is a good interaction. If a good interaction is happening among the players, right? So you will be mostly finding a consolidating markets where market finds the liquidity, whereas a low liquidity zone. So these are low liquidity zones where a trending auction happens. Trending auction happens, stop loss hunting happens. So those are typically low liquid zones, right? So generally institutions love to place limit orders in a liquid zones. That is the right way to put into it. But they also use the tools like market orders to drive to find the liquidity. So what you can track from the order flow? You can track many things from the order flow. You can track the momentum behavior. You will be able to track momentum exhaustion, where the momentum exhaustion is happening, where the momentum is happening, where absorption is happening, right? At times when the price is going down, you can find a lot of price absorption happens. That will create a kind of a ceiling effect, right? So it's kind of a distribution or kind of an accumulation where the common term is absorption. Kind of the price goes down and it will be absorbed by the limit orders mostly. So again, you can also figure out where the stop hunting happens. You can also figure out the trader's confidence also. You can also figure out the trader's confidence from the order flow. With the way the behavior is going on in the order flow, you'll be able to track the trader's confidence. That particular day, how the participant confidence is there for the day or at that given moment, what kind of confidence is going on. And you'll be able to spot out which auction is stronger auction, which auction is a weaker auction, which I'm going to talk in the afternoon session. So at any given time, there'll be three dominant market participants will be there. One is mostly financial institutions. Their objective is to mostly long-term players because they are mostly funds. 80% of the funds are long-term oriented funds, and only 20% of the funds they play long-short funds or arbitrage funds. They're mostly trading money kind of funds. Next comes the speculator. Typically, they are short-term. Typically, they are intraday players. Next comes the market manipulators. Market manipulators are market makers. They supply liquidity. They will be present in the markets only from an intraday perspective. They don't try to predict the markets, which side the market could move. Mostly they play with, they come and supply liquidity and they hedge their positions on the other side. And the market manipulators, at times they are the one who comes and hunt the stops, move the liquidity, move to the next liquidity zones, right? So, but they operate at a very short-term level or an intraday level. So the key thing is what is dominant, who is taking dominance at any given time. It is not about who is dominating at any given time. There is not one guy is going to dominate at any given day. There is a layers of group over here. There's a multiple layers of crowd is going to be there. There are the layers of intraday participants, layers of short-term participants, layers of long-term player participants. But at any given time, only one group is going to remain dominant. Either a group of intraday players, a group of short-term players are going to dominate in the market on that any given day. The dominant crowd does the most of the impact to the people. For example, something like an event day, like an demonetization, where the market opens with a big gap down, it triggers a lot of liquidity. That is where institutions' presence will be there. That is where the long-term players love to accumulate. So that particular day, a layer of dominance presence will be visible from the long-term players, right? So where the opposite community come to sell, they provide liquidity, and the people want to exit, whereas the counterparty will be mostly absorbed by the financial institutions. All the selling activity will be absorbed by the financial institutions. Where if you look at it on that day, you find a lot of sellers throughout the day. Throughout the day, it will be completely on a, let's say the demonetization, one day before demonetization, price was here. The next day, Nifty opened gap down 500 points. 500 points. It triggers a lot of panic among the participants, right? So what will be happening throughout the day is that the aggressive players will be selling the markets again, but the buyers take it down. Again, aggressive players come and sell. The buyers take it down. Aggressive players come and sell the markets. They take it up. Again, aggressive markets. The aggressive players, they come for a sell again, because it's an even full day. Demonetization is something bad. That's how the people behaved on those demonetization day, where at every price level, new sellers are finding an opportunity to exit their old position. They're coming for liquidation. But despite that, all these selling activity is absorbed by the institutions. All these selling activity is absorbed by the institutions, means institutions might be present on the other side in the form of a limit order. because they see an opportunity to observe all those liquidity, which is supplied by the aggressive sellers. The aggressive sellers are finding an opportunity to sell, whereas the institutions are finding that as an opportunity to be on the other side and observing all those selling activity, right? So the entire day, if you would have been seen on that day, you would have been seeing a lot of negative delta formed in that day, but still the day would have been completely went up, because that day would have been complete. All the selling activity would have been initially observed by the institutions in the form of limit orders. But lately, to find the liquidity, they would have been driving the price up. Lately, they would have been aggressively coming and participating. They might be finding as an opportunity to add more to their positions. So they might be aggressively pushing the price up to find more sellers, right? So if you take any markets, the market keeps going down. As long as the aggressive sellers are in control in the markets. When the aggressive sellers are losing control, that is where the aggressive buyer takes control and they move the market up. As long as the aggressive buyers are losing control over there. Once the aggressive buyers are exhausted, automatically, even with the low volume, sellers could be able to take control and they could be able to move the market on the other side. So if the market has to keep going forever, they need a strong liquidity presence, and the buyers should be aggressive forever, as long as they keep on driving up and up and up and up. That means the aggressive players are in control in the market. As long as the aggressive buyers are in control more than the aggressive sellers. At any given time, there will be aggressive buyer also, aggressive seller also. But if aggressive buyers are more, as long as they are more, they pushes the market up. Once they lose control, even with the low volume, aggressive sellers can take control and they can push the market down. This is the behavior you're going to see in order flow time to time. So a good market always keeps going up as long as aggressive participants are present in the markets, right? So there are multiple modes of order flow over here. One is bid and ask. We already talked about bid and ask imbalance. The other modes are delta percentage, order flow volume, delta shaded volume, high low volume. So these are different studies, but I prefer using delta, bid and ask imbalance, and I use delta. Not every time. Most of the time I'll be using this 80% of the time. And to check if there is any player positioning, we use delta studies. So this is not every time, but whenever it is required, I'll switch back to delta and to check whether there is any delta packet positioning is happening or not. Any interested parties are entering at that certain levels or not. That is the one thing we try to look from the delta studies. Other studies are nothing but a different variation of order flow, right? So, but then you don't need to use all those studies. You have to check which one suits for you. You have to go with that. Mostly bid ask imbalance gives a lot of idea about where the momentum is happening, and bid and ask it shows about where the maximum participation is happening. In terms of participation, if you want to look into it, the bid ask ladder is going to help you. Actually, bid and ask imbalance going to show the same data, but it is a different pictorial representation in the form of shaded colors. That's the only difference. Whereas the bid and ask shows where the maximum participation is happening, where the less participation is happening. Whereas the bid and ask imbalance, it talks about where the maximum momentum is happening at any given level, whether that particular price is driven by momentum buyers or momentum sellers. That is what you'll be able to figure out. And delta, you will be able to figure out where the maximum interested parties are, right? So again, the order flow volume talks about where the volume activity is taking place, at what level the more volume activity is happening. You can able to get that. Again, delta shaded volume, again, one of the variations of order flow volume charts, where it is color coded based upon the delta. So wherever the delta is higher, you will be getting an lighter shades. Wherever the delta is lower, you will be getting a darker shades over there. So that's how the delta colored volume happens. So you don't need to, as I said, you don't need to use everything. You can still stick to the basics. I prefer sticking to this 1, 2, 1, 3. These are the maximum I'll be using it, and I prefer to use this to check if I want to do some volume analysis or something. But 99% of the time I want to use the top 3. So this is how a bid-ask volume looks like. As I said, the lighter shades are where the bigger volume is happening, and the darker shades are where the lower volume activity is going to happen. And you are going to find a box of red over here, which is nothing but the volume point of control, where the volume is maximum compared to any other price level. So if you sum up the volumes over here, the volumes are more at that price zones compared to any other price level. Next comes the bid-ask imbalance, where you can see a block of you can see this here. You see a block of selling activity over here. We compare diagonally, and if it is more than 10, I prefer 10. The default settings are 3, but I prefer 10 to identify how bigger the sellers are. I mean, how aggressive the sellers are. Those blocks shows how much aggressive they are. That means where the momentum selling activity is getting developed over there. So if you are finding, let's say if you're taking a block over here, and if you're finding that the aggressive selling is happening, in this block, and it's happening in this block, and it's happening 3 blocks continuously, then that shows that they are stacked sellers. Similarly, if you are seeing stacked buyers, then the stacked buyers will be present on the right-hand side. On the right-hand side, we'll be finding in stacked buyers where the volume will be 10x more compared to the sellers. So all these zones will be dominated by a minimum 3 blocks is required to figure out, to say that it is a stacked imbalance, right? So momentum buyers are entering in the zone. So momentum buyers are entering in the zone. So those blocks can be continuous, or it can also be non-continuous, something like this. You can see that 1 block over here, again 2 blocks over here, 1 block over here, again 1 more block over here, 1 more block over here. So total 6 blocks it is showing. Total 6 blocks where the momentum selling activity we are able to witness. They are not continuous, but even if they are not continuous, also we can say like it's a stacked momentum sellers. They're coming in a sequence that sellers are completely in control in the markets. And again, you can see again a stack of momentum sellers coming into the markets. They are stepping into the markets. Whenever you are able to spot a momentum occurs all the places. But where the momentum is coming in, that is what it tells you what kind of day the market is showing confident. Whether it's a high confidence day or a low confidence day, you'll be able to figure it out. Then generally, when the stacked imbalance is coming at a key reference level, let's say something like a rally high in market profile, it's coming exactly there, then I can say like for example, let's say there is a 2-day high is there. 2-day high is there. 2-day high is there. And initially price drives up and it takes the 2-day high. Takes the 2-day high. And when it is coming down at this level, if you look into the order flow charts, if you are seeing a lot of momentum sellers happening there, momentum sellers are coming and selling exactly, they're pushing through the previous day low. That is a very initial sign that this day could be a possible low confidence day. Maybe they are pushing really hard at the 2-day high. So maybe they are smart enough to drive the price down, build some activity, and later you could see some sort of plunge later on. So where, at what location this momentum selling is happening? This momentum selling, it can happen anywhere. That is not that's not a big deal. But at what location it happens, based on that, we'll be able to say that whether the day could be a low confidence day or not. You'll be able to say beforehand, before at the 2-day low, when the price is about to break out itself, you'll be say that when you're seeing a thick sellers coming in, you say that probably this day could turning into a low confidence day. So you go and follow them. Maybe that could be in a stronger auction. Go and follow them. So maybe the market is not interested in staying above 2-day high. The markets is not interested in saying about today high at all. So that reference level is a crucial reference level where you should think about shorting at the 2-day high itself. And when you're seeing that level, probably your entry zones, that's an immediate entry intraday zones to scalp or to take an intraday trade at the 2-day high and expecting price to do some inversion activity. So that is the primary reason I look into bid and ask imbalance, to check where the momentum activity is happening. If it is happening at a key reference level, then I go with the momentum. Otherwise, we don't trade every momentum. We don't look into the momentum at every price levels. Generally, I prefer momentum coming at my key reference level. I consider that as a good strong auction over there. Next comes the order flow volume at price, where instead of bid and ask ladder, you'll be seeing a total volume which is getting traded over there. So this includes total buyers and total sellers, which is nothing but a volume profile at each and every candle. It's nothing but a volume profile at each and every candle. So these are the total volume which is get traded at each and every price. That is why it's called as a volume at price. We call this a VAP also. It is like the total volume was 3,448 lots at any given candle. How this 3,448 volume got spreaded over each and every price level, that's what the VAP shows. That's what the volume profile talks about. So here the maximum volume was happening over here, whereas the rest volume was happening at the edges. That's what you can understand, but otherwise you cannot bifurcate. This will not bifurcate and show you buyers and sellers, but it will show you only the total volume at each and every price level. This is a different representation of order flow. Again, delta flow. Delta talks about the net difference between, what is a delta? The delta is nothing but total number of buyers in that particular candlestick minus total number of sellers in that particular candlestick. So if you are seeing in green color, that means buyers are in control. The delta value is positive. If the delta value is positive, that means buyer controlled at that price level. Delta is positive means the buyer controlled at that level. If the delta is negative, means sellers are controlling at that price levels. So you're going to see a delta here. If you look at the table here, this is the total delta for the candle, But if you look into the delta flow at each and every price level, right, there will be a bid also, there will be a buyer also, there will be a seller also. But if you look into the order flow charts, let's say 100 volume got traded over here, whereas only 50 volume got traded over here. So 100 minus 50 is 50. The delta is 50 at that price level. So it prints a 50 over there. Likewise, the delta will be printed at each and every price level. So we can also say like delta at price. Instead of volume at price, we can say like delta at price, where the delta is measured at each and every price levels. So we can use this delta flow to understand how if there is any major players are getting positioned before the move is about to get initiated. We call that as a delta packet positioning, which I'll be talking in the afternoon session, where we'll be showing the delta charts to explain where the big buyers or big sellers are initiating the interested parties are coming and initiating positions over there. That you can able to figure out from the delta flow. And as I said, there are zero liquidity zones. They are stop hunting zones, and where it's kind of an intraday gap, which you will be able to spot out from the order flow charts, which is mostly it comes and refill those zones. So you see the liquidity stop hunting happens. All in a sudden, market themselves, they reposition themselves and they go and revisit those low liquidity zones. So these low liquidity zones are usually it gets covered in intraday with a greater odds. So as an intraday trader, what you should not do is that whenever you're finding that liquidity zones is there, and if you want to sell further, you have to be aware that those levels can be revisited. So one of the, if you want to sell in this market intraday, you know that the consequence is that the price can come back again and revisit those trade locations. So usually it gets cleared faster. And at times it gives you an opportunity also. Not every time a stop hunting is going to give you opportunity. At times when there is a stop hunting and price is going to go down further, let's say you're seeing a difference of 30-40 points and you are seeing a momentum exhaustion there. One of the target locations, always the target locations are stop hunting locations, right? So this you have to keep it in your mind. Again, this is a pictorial representation. So the aggressive buyers or sellers are market orders, they move the markets. And passive buyers or sellers, they are nothing but a pending limit orders. They're just waiting for the fill to happen. So here is the basic building blocks of order flow, where on the right hand side you are seeing buyers, on the left hand side you are seeing aggressive sellers. And there is one more block here, which nothing but the commitment of trade. At the highs and at the lows, you are seeing a commitment of trade from the, this is seller commitment, and this is the buyer commitment. Similarly, we have one more term called contract reversal. Both the contract reversal and commitment of trade, it shows the buying pressure and the selling pressure at each and every candle. Nothing much there. There's supplementary information to the order flow, which helps you to identify how much is the buying pressure or how much is the selling pressure at any given candlesticks, right? So again, contract reversal, which I'm going to talk about, this is buyer's contract reversal. That's why it's represented in a green color, and the one which is color in a light shaded red is nothing but seller's commitment of trade. So the top one is the CR. CR represents contract reversal, and the other represents COT. They both are supplementary information to order flow, which explains the pressure point, selling pressure points, selling pressure in that particular candle, how much the sellers are putting effort. It talks about the seller's effort or seller's pressure compared to the buyers. Bigger the number, more the pressure is going to be, and lower the numbers, the lower the selling pressure is going to be. That's how it has been interpreted. But we'll look into in detail about what does that COT and what does that CR usually means. They are nothing but derivative of the delta. So it's a formula which is derived from the delta, minimum delta and maximum delta, and from that they figure out what is the seller COT or a contract reversal, what is the pressure which is actually going on. I'll talk about it in detail, but first we'll complete the basics. Again, as I said, these blocks, the red color blocks, are where the high volume point, or we can also say like high volume nodes. They are mostly high volume points or high volume nodes. So what is the ideal order flow settings? What is the ideal brick size I have to keep? Right. So if you ask me, here is the optimal pricing. I mean, here's the optimal tick size which you can keep for something like a Nifty. For something like a Nifty, we'll use an 1 point brick size. That means that will be multiplied by 0.05, and so I have to key in 20 over there. So I have to key in 20 over there. So when I say when I key in the brick size or the price per tick, when I key in 20, it gets multiplied by 0.05. In turn, what I'll be getting is each and every 1 point, I'll be getting a block of buyers and sellers activity gets recorded at each and every 1 point interval. And something like Ashok Leyland, or it comes around 100 to 250 range, where we'll be using 10 paise. Every 10 paise interval, we'll be recording the buyers and sellers activity. And that means in my order flow settings in NinjaTrader 8, I have to set 2 over there. Something like USD INR, I'm going to show you USD INR. First of all, when you want to set USD INR, the USD INR, let's say I'm going to set for USD INR.
How about Bank Nifty?
Bank Nifty, I prefer using 2 generally. So let's say I open Bank Nifty first, then I'll open, I'm going to duplicate this so that I'm going to get the same settings, same templates. Where it is going to plot for 1 point interval. And I'm going to, at the same time, I'm going to open for Bank Nifty. So Bank Nifty, the range is getting bigger, so we cannot use a 1 point interval. So what you can do is a right click, go to, you'll be seeing a lot of candlestick, a lot of data points, which is tough to read in one single candle because it doesn't make any sense to us. So in that case, what you can do is that you can go to right click, go to indicators and change it to 2 blocks. So you make it as 40. Make it as 40 means each and every block will be 2 points of trading activity recorded. As long as the price is trading within the 2 blocks, the buyer and seller activity will be recorded over inside that. I mean, these zeros are coming in because of I haven't connected to the data, so that is why the zeros are coming in. If I connect it to the data, it will supply it. So it records the 42 means inside that 2 point range. Inside that 2 point range, 42 lots got traded, and it is not coming at one price, but inside that complete 2 block range. That two block could be around anywhere between 27617. Between 27, these are the 2 price it could be. So 27616, right? So between this price level, any activity got generated that will be considered as 1 block. Within that block range, 42 lots got traded. That's what it means. Something like an USD INR, let's say I'll duplicate this further. Then U tab. Let me bring USD INR. USD INR usually doesn't move. I'm using a 20 over here, so ideally 20 is not the ideal option to get for you won't so what I used is I used a 20 over here. First of all, the lot size has to change. The lot size for USD INR is 1 and apply. First, you need to figure out what is the tick size for the USD INR. So let me figure out the tick size from the, I'll go to control center. I'll go to tools, instruments, where I'll bring USD INR. I select USD INR and press edit. You could see that the minimal tick size is 0.0025, right? So 0.0025, that means if you want to plot for, if you have to keep 2 as the TPO size, that means every 2 ticks movement, every 2 tick size movement, a block will get formed over there. So instead of saying 20, I should be using 20 over there. I'm going to disconnect playback. I'll connect to global data feeds. And I'm going to set for the USD INR. My data feed is getting loaded. Continue. Meantime, I right click and I'll go to indicators. Okay, the data has to load first. Let the data load first, then I'll readjust the tick size, the TPO size. So right click and I'll go to indicators. We'll make it as 2 here. Apply. That means the 2 will be multiplied with the tick size of 0.0025. That is the minimal possible movement in USD INR. So now you will get a better block zones, which is suitable for reading the order flow charts of USD INR. Otherwise, 20, if you put 20, every 20 ticks, it will try to put 1 bar. Hardly you will get only 1 buyer and seller block for that thing. Here you can, each and every 2 ticks, you're going to get a block here. Each and every 2 ticks, you're going to get a block over here. That's what, that gives a nice readable representation of the order flow charts.
Hello, sir. Just show me crude oil for crude oil purpose.
I don't have the data in this machine for crude oil.
Okay. Sir.
So I'm studying currently Nifty and USD INR activity mostly. So that is why I have an access to currencies and stocks as of now. So if you want to set crude oil, the tick size is 1. Minimum possible movement is 1. So you have to use 1 as the value in your TPO size. Just put 1 and So you have to right click and you have to go to indicators. Your tick size is already 1, and your brick size also should be 1 over there, so that you will in a low volatile markets, 1 should be enough thing. If something like a crude oil is making a move of 3% or 5% in a day, then you can consider moving to a brick size of 2 in case of crude oil. But if you are using for stocks, you can follow the simple principles which is listed over here. Just you can follow the settings as per the price. So these are the software settings you have to key in. No matter what, most of the software order flow futures uses the same price per tick or the brick size or the TPO size that they might be using in a different terminologies. Again, the delta representation is set here. The delta is nothing but the total number of buyers minus total number of sellers. So all the aggressive buyers put up minus all the aggressive sellers, you get the delta value. If the delta value is positive, that means buyers are in control in that particular candle. If the delta is negative, then sellers are in control in that particular candle. And next comes the action bar. You would have been seeing in one more additional bar in most of the order flow charts. So always the nearest bar which is available to the price axis, right? So nearest to the y-axis is an auction bar, which always displays last 5 levels of trading activity. As the price moves up, again it shows the from the last traded price, last 5 trading activity it listed down in the form of an bid and ask ladder view by default. But that control also can be changed. I really don't look into the auction bar all the time, but it's only a representation of what happened in the last nearest 5 bars activity from the last traded price. That's what it shows up. And if the price is ticking up, the auction bar also moves up to the new high. And if the price is going down, then you can find the auction bar again shifted down. The next bar is where the current running candle is moving on. This is the candle which is going on. So this is a candle you'll be seeing ticking up and down, up and down, up and down. And that is a very recent candle formation which is happening right now. Whereas the auction bar, it's again a supplementary information for our order flow. And order flow table or order flow dashboard, where the table comes with a multiple representation. By default, I prefer using delta, max delta, min delta, cumulative delta, and volume. So volume is one more level I prefer using it. So, but there are multiple. You can have if you go to the table, you can enable or disable whatever you want. So one is the session letter. So let's say I'll go to Nifty. It shows the market profile letter, what letter is currently running in. So when I say the letters are reading M, that means I'm in the last 15 minutes of the candle. I'm in the last 15 minutes of the candle. If it reads letter A, that means I'm from the market profile perspective, I'm in the first half an hour of the candle. So you know what time is currently running on based upon the letters. So the letters are related to market profile. And then the ask and bid, it talks about total buying quantity, total selling quantity, which I personally don't use. But if somebody want to bifurcate the total volume into buyer volume and seller volume, they can go and use this. Personally, I don't use it. I will be using delta mostly. I'll be using delta. I'll be using max delta. I'll be using minimum delta. I'll be using cumulative delta. There are a lot of variables available. I'll be using volume, and I don't use total tick volume. Total tick volume is all about on the left hand side. The total tick volume, the bid and ask histogram. If you don't want, you can disable it. Right? So it's good to have a view what is happening over there. Or if you want to keep it minimal, let's say you can remove that bid ask histogram. If you don't find it interesting, you can remove it. It depends upon user to user settings. They can enable or disable whatever they want. Right? Again, there is auction bar settings over here. Auction bar settings are the last. This is the recent bar, right? So this bar we call it as an auction bar. By default, it will be in bid ask mode. But still, if you want to keep and to measure only bid ask imbalance, or if you want to see that as a delta, or if you want to see that in an order flow volume, you can have a different representation only for the auction bar alone, right? So again, getting back to the PPT, it also comes with a delta. So you can see a sequence of delta here, a positive delta. That means buyers are controlling in these candles. Maybe you might be seeing price going up and up and up and up continuously. You might be seeing the price keep on going up. Again, order flow blocks, we already learned this. Seller COT, seller CR, buyer COT at the bottom and buyer COT at the bottom. You can also have a delta representation. The delta representation is nothing but the total buyers minus sellers. If you see this, it will be the 13 minus 0. Again, that number will be plotted. Again, 13 minus 0, that number will be plotted over here. 56 minus 63, it is minus 7. So minus 7 means that sellers are controlling at that block. You can see 297 over here, which is nothing but 344 minus, always buyers minus sellers. But always buyers minus sellers. If the value is negative, then you can see the sellers are in control at that price locations. That's how the delta candle got formed. So now let's think about this. What are the places where you can spot an intraday reversal from the candlestick? Ideally, from the price charts, it's tough to spot where the trend reversal is about to happen. But if you look closer into the order flow, let's say I'll go to the order flow charts. It gives you more brief introduction over here. You can see a lot of clustered momentum sellers. You can see a stack of sellers over here, coming over here. Again, you see a lot of stacked sellers coming over here, right? So a lot of stacked sellers where the comparatively compared to the diagonal pricing, it's more than 5 times or 10 times. Where you can able to spot a trend when you are seeing in clustered momentum sellers, usually they are aggressively controlling the markets. Markets tend to go down, or whenever the price is coming back to the aggressive selling activity, again aggressive selling activity resumes back. So those are the places where the interested parties are there in the markets. At times you might be going to see the clustered momentum sellers. As I said, whenever you are spotting a clustered momentum sellers, it's all about where the clustered momentum sellers are coming in. Maybe I'll try to show you an order flow example, which I done some time back. So this is one of the day, I think it is on 3rd of October, I believe. You can see the volume cluster coming over here, the clustered buyers. So there is a clustered buyers over here, clustered buyers, momentum is happening. Again, clustered buyers, momentum is happening over here. Usually momentum buyers, which is followed by momentum buyers, are a sign that that market could go up. That is one of the scalping opportunity when you find a clustered momentum buyers. So, and as I said, at what location the clustered momentum is happening, that is again, it's going to give you more importance to it. the momentum buyers are stepping in over there. Again, you see one more stack of momentum sellers, momentum buyers are coming in. One more stack of momentum buyers. At times they come in the form of clustered volume. So that means the momentum buyers are really pushing the market hard. That momentum zones is where you can keep a tighter stop. And you can do from scalping, for scalping some 20, 25 points opportunity. That is why whenever the momentum buying activity is happening, mark those reference levels. So those are the reference levels they will be defending for your scalping opportunities.
Master, what is the best time frame? Like 3 minutes or 5 minutes or 1 minute?
So I prefer using 3 minutes or 5 minutes. 1 minute I never tested it, so I mostly prefer using 3 minutes or 5 minutes.
Okay.
1 minute hardly you won't get any activity at all, right? Within 60 seconds, what activity you can anticipate? Right. How do you know that momentum buyers are present or not? So at least you need a 3 minutes or 5 minutes to justify that momentum buyers are present in the markets. If you are using 1 minute, then probably you have to be a scalper. You might be, your holding period will be anywhere between 1 minute to 5 minutes. If your holding period is like that, then you should consider using it. So you're a very, very fast scalper. Again, you can see one more momentum buying activity was happening here. That's why the stack buyers are coming in over here. All stack buyers. When you're seeing that kind of stack buyers, that is a sign of a good strength auction. A good uptrend will be.
Stop loss is there. Stop loss and entry point.
Stops are, as I said, the first where the momentum is happening. That is first important. The momentum, if it is happening, let's say, initially the momentum happened over here, right? Initially the momentum happened over here. Let's say the momentum is happening at the previous day high. You're seeing a momentum and one more momentum is coming in, and that zone is an interested zone if it is coming at a previous day high. Assume that this is previous day high. Whenever the price is crossing the previous day high, you are seeing a lot of momentum activity coming in. That zone is a crucial zone to place a stop over here. The stop will be at the day high itself. You can keep a stop, and you can ride the trend. If they are interested parties, whenever the price comes to that level, pretty closer to that, again momentum auction happens. This has to be combined with the market profile confidence. So if you're seeing, if the day high is broken with the good buyer confidence, exactly the momentum is happening at the previous day's high, then it is a good sign of a continuation. It's a good sign of a continuation. Whenever the price comes down, they will come and defend down there, where you can keep a momentum stop, and you can only do scalping. So you cannot look for some bigger points like 100 points or 20 points, but if something like a 20 points or 25 points, you're done, you're out of the game. And again, you have to start looking for the next opportunity. Right, so this is only to demonstrate how the momentum buyers comes in a good trending markets. Now, they often come in the form of a clusters, momentum clusters. A good sellers will be coming, like a good seller is pushing the order. Again, it's follow through, more aggressive sellers are coming in. So that is how they drive the price down. Again, now we can see the aggressive is not that much, but still the sellers are present in the market, but they are not aggressively pushing the market down. So a good selling market, you'll be often going to find this kind of clusters. Again, they may not be coming in cluster for some time. Again, the sellers comes and pushing the markets in the form of clusters. That is a good trending auction. But at times, when you want to spot a reversal, what you'll be seeing is that the momentum sellers the momentum sellers will be aggressively present in the market. You can see a lot of aggressive sellers are in the markets, pushing the price down, which is counterattacked by the momentum buyers. That is a sign that whenever you're seeing a momentum selling activity is counterattacked by a momentum buying activity, so most of the time what you can see is an price often mean towards back towards the VWAP level. The VWAP level is the brown color bands which you see in order flow. So those are often, whenever a momentum sellers are counterattacked by a momentum buyers, price usually tend to move towards the VWAP level. That is one of the trading strategy which you have to look into, where we call that as a momentum trend reversal. The momentum sellers are counterattacked by momentum buyers here. You can see a pack of momentum, almost layer of 4 momentum coming in, which is counterattacked by 5 momentum buyers. We need anything more than 3, we call that as a momentum buyers. For example, we don't call this as a momentum selling activity because it's just only 2 happened over there. And this is also not a momentum selling activity. This is also not a momentum buying activity. We tend to ignore these kinds of informations, but we give more preference to anything more than 3 or 4, which is happening in a single candle, either which is coming at a complete stack. We give more information. We give more priority to it. Right? Again, this is a momentum buying activity. Again, this is again one more momentum buying activity. You can see that initially momentum sellers are trying to push down. Previously, price was coming down, and finally, more momentum sellers are trying to push down. But later on, the momentum sellers are lagging in the markets. They are not aggressively dominating the markets. So lately, the markets went up, despite the markets are pushed by the momentum sellers, because after that the momentum sellers are lagging control over there. So who took control over here is that momentum buyers are taking control. Again, momentum buyers are coming in clusters. They're coming in clusters, and they are coming in clusters. They are coming in clusters. They tend to mean revert towards the VWAP level. Once you're done with the VWAP level, and you should be out of the game. So that could be typically some. At times it could be 20, 25 points or 30 points. It can go in case of something like Nifty. Or if it is in case of Bank Nifty, it can go anywhere between 50 to 75 points. Again, you are going to see something like this. There will be a momentum sellers with a big volatility candle followed by a inside bar. That inside bar is a clue that that entire selling activity is now absorbed by the buyers, and now later on the buyers are trying to push it up. Later on you can see a lot of momentum buying activity happens over here. Later on they push the price up again, right? So this is one of the strategy which we will be following in the form of momentum auction reversal. I'll talk more about it. But if you are seeing a lot of momentum sellers, followed by an inside bar, a neutral bar, and then lately momentum buyers are showing up, that could be also one sign of a trend reversal. Again, you can also watch on any time frame. It's not just you have to watch out in 5-minute charts. So if you are looking from a positional trading perspective, you can go and check on a 30-minute time frame. Maybe I'll show you the 30-minute time frame what happened in Nifty. Or let's see it in Bank Nifty. Okay, let's say instead of 30-minute charts, I'll show you in Bank Nifty 30 minutes. Let's try to understand what kind of activity happened over there at a 30-minute time frame. Okay, so this is a 30-minute time frame. So where the volume was maximum here on a 30-minute time frame. Of course, the number of lot size is it a 30-minute time frame? Yeah, it's 30-minute time frame. can reload all historical data. This doesn't look like a 30-minute candle at all to me. Okay. Anyways, this is not plotting 30-minute charts because this is not having enough data points as of now, because most of the data vendors, they provide up to last 2 days of tick level charts. So I prefer to to explain everything. I'll prefer to stay within 5-minute charts, unless you are going to use e-signal, right? So e-signal provides up to 15 days of historical tick data. So when talking about data vendors, if you're going to use global data feeds are true data. It usually provides 2 to 3 days of tick level information, which you can use it for scalping purpose. But you cannot get a high level overview what happened in the 30-minute charts. You can get it, but you need to have the data continuously coming into your screen. You should not close the charts at all. I mean, if you would have been closing the charts for 1 or 2 days and you're coming back again, you will miss 1 or 2 days of information, and you cannot plot a 30-minute charts or a hourly charts. It's meaningless. But something like a e-signal vendor, currently they are providing by default 15 days of they provide 15 days of tick data, and that is a lot of information, and which you will be able to figure it out. If you want to plot a 30-minute charts or a hourly charts of order flow charts, you'll be able to get it. And they have one more feature called extended intraday data. If you want to use it, the tick level will go up to 45 trading days. So where you'll be able to plot 30-minute charts, order flow charts, or it's good to study and hourly order flow charts. It's good to do with the e-signal kind of vendor, but as of now, Indian data vendors, they cannot provide it because it's going to cost a lot of money to them in terms of bandwidth. It's going to eat a lot of bandwidth. Most of the Indian servers, they charge for the bandwidth. So I'm sorry. As of now, they are limiting to only 2 to 3 days of tick level information, whereas e-signal, which is a bit costlier, because these guys will be usually comes around 2000 to 2500 range, 2000 to 2500 range, anywhere between that. Whereas the e-signal usually comes around the bare minimum of anywhere between 10,000, 12,000 to 18,000, depends upon what kind of data pack you want to use. So it's a bit costlier. This is per month charges. So initially I was a e-signal user as long as GDFL is not providing tick level data. So I was using e-signal from 2013 to 2015. I was using e-signal. Almost 3 years I closely used e-signal, but later on, once global data feed started providing tick level information, I moved from e-signal to global data feeds. I completely moved to global data feeds. I don't use e-signal anymore. But yes, e-signal is one of the good product which comes with international quality, but it comes at a greater pricing. It's worth paying. It's worth paying if you are really serious about multi-markets data. You can get Japanese market data, you can get European market data, or you can get CME exchange data, crude oil, NYMEX crude oil, or CME gold. So you can get any, almost they provide up to 196 countries, cash, futures market data, commodities market data. Every market data will be available, but it is for the premium vendors. But if you're going to trade single markets or only NSE or MCX, you don't need any such kind of greater products. All you can do is you can only stick with global data feeds. But the only problem as of now is that they provide only 2 to 3 days of tick level information. That means you cannot go and replay back some 30 days back what happened. You cannot go and do a playback unless you don't have that tick level information. So whenever the price is approaching the previous day high, so here this is one of this example. So there is a previous day high is here, and you're seeing a lot of big candle is coming over here, and see that price is getting rejected at the previous day high. Well, now let's have a quick look into what is happening from the order flow perspective. So you see that again, price got rejected at previous day high. Again, previous day high, price is coming and testing, it's falling down. Again, price comes and testing previous day high, it's falling down. But if you look from the order flow perspective, what it would have been looks like. Let's see, slide. So if you look from the order flow slide, you would have been seeing that when the price goes up at the previous day high, you are seeing a lot of momentum sellers. That is where you would have been stepped in, or that is one of the reference level. That range will act like a resistance. If it is coming at a previous day high, every time the price goes up, that is an opportunity to sell the markets. Again, price goes up, opportunity to sell the markets. You generally going to see a lot of selling pressure is coming here because they could be interested parties. They could be the interested parties who's coming really coming and pushing exactly from the previous day high with a greater push is coming in. Then that acts like a kind of a resistance zone for the day. So we'll be marking a zone saying that this is where the interested parties are coming and selling. Every time price is going to reach this zone, every time the price is going to reach this level, you're going to see some sell-off. And that is where the scalping opportunity begins over there. So that you can use this as a reference to short sell, to initiate a short sell along with them. These kinds of levels, this level can be a high, previous day high or 2-day high, especially when at the key reference level, you're seeing a momentum. That reference level is very crucial, and that's going to give you some scalping opportunity for the day. This is one of the examples from Bank Nifty. On that day, we spotted in the Slack as well saying that momentum sellers are coming at the day high. So you can initiate some shorts. So what happened on that day is that price was traveling sideways for some time. Again, momentum sellers came. It closely given 120 point of trading opportunity in Bank Nifty on the downside. So this is how the activity happened. So momentum sellers initially came, and again momentum sellers came. It's a kind of a clustered momentum sellers. And again, price was trying to revisit very close to previous day high. Again, there was a sell-off. Again, momentum sellers came. Momentum sellers are stepping in. You can see big deltas. The day is coming up with a big delta candle, and finally it almost closely moved down 100 plus points in Bank Nifty. This chart is from Bank Nifty. We check if I'm able to get the complete picture of the charts. Yeah, the x-axis got cut. But that's a Bank Nifty contract. So where you have to measure the confidence, where you should expect the momentum. At the opening, you can see whether the momentum is coming or not. At previous day high or previous day low, 2-day high or 2-day low, multi-day high or multi-day low, or previous week high, previous week low. These are the points where you can look for the momentum is coming in. So if you're a market profile player, you can to check whether the acceptance is coming on a rally high. Let's say last Friday we had a rally high, right? So last Friday we have something like this. We have this kind of pattern in Nifty, and when Monday price is going to open and it's going to cross, is it crossing with a greater momentum push? That's what you have to look into. This location when the price is crossing here, are you seeing serious buyers initiating, defending that level to push the price further up, is the momentum buyer are coming at that level. That you have to watch from order flow. And again, that gives the confidence that to keep a stops below that level, and to go and attempt towards the market on the upper side. That gives you a tight stop also, in fact, so that market moves up, it comes with the momentum. Maybe what could happen is that initially market could go up without low momentum. Again, market comes down. But this time when the market is going up, really, you will find a lot of momentum buyers here. And that means even if they go up, next time they comes down, they defend it. You can see some nice activity getting kicked in. That's the only information you have to watch out from the reference. At the reference, what you want is a momentum buyers. If momentum buyers are stepping in, then that is your primary support zone for the day to initiate trades, to time your trades, so that next time the price comes back into the zone, you again expect more momentum buyers will be stepping in again. So this is one of the examples how the momentum traders behave. So if you look into the order flow charts, momentum sellers, when a sequence of momentum sellers are coming in, which is counterattacked by the momentum buyers, these are the zones where momentum buyers are counterattacked by momentum sellers. At the tops, at these swing tops, you'll be seeing momentum buyers take control. Momentum buyers take control and they move to the extreme. And again, momentum sellers comes there. They push the market down and they move to the another extreme. Again, momentum buyers take control. They push the market up. And in a continuation pattern, in a downtrending continuation pattern, you're going to see a lot of clustered momentum sellers over there. That's what you're going to see from the order flow charts. If you look closely from the order flow charts, the momentum buyers or sellers are typically going to come in the form of momentum. Mostly at the edges, if you are seeing a buyer, the markets are going down, and completely you're seeing a momentum seller followed by a momentum buyer. That is where the trend auction reversal happens. There is one more indicator called the delta candles. The delta candles always talks about cumulative delta. So we haven't talked about cumulative delta yet, but if you look into the candlestick charts, you look into the order flow charts, there is one more variable called cumulative delta. The cumulative delta always starts with 0, and it starts accumulating the delta for that particular day. So it always starts with 0. When the day starts, the cumulative delta also starts. So we'll look into Nifty. Go to the date start. Here's the market starts. When the market starts, the delta starts with 0, and as the buyers and sellers started colluding, it started recording the delta activity. So initially the delta was positive. And it records the same as the cumulative delta. So the cumulative delta starts with 0, and it records first candle activity, 400 buyers are there. And next candle, you see that the only delta is -2. That -2 will get added to the previous value, and it becomes the 417 becomes 415 because of that -2 delta. Next candle again -157. So that -157 will be added to the previous value of 415. That means it becomes 258. So as the day goes by, it keeps on recording the information. So end of the day, what we got is end of the day. If I come to the end of the day, the cumulative delta, the reading was 9,000. Okay, not 9,000, 7,728 minus value. The value was represented in terms of minus. That means that particular day, the delta, cumulative delta was -7728. That means 7,728 sellers present in that market on that day compared to the buyers. Compared to the buyers, 7,728 seller contracts are more. That's what it means. That means overall the day is controlled by the sellers. That particular day is controlled by the sellers. And typically, if they are institutions, when institutions are participating, these kinds of negative delta are mostly is going to favor the bulls. It's positionally good to carry forward long. That's the only information you can gauge from Nifty. So cumulative delta, we have a couple of strategies. We'll talk about it in the afternoon session about cumulative delta. Usually in earnings season, if the cumulative delta is getting negative, what you will be seeing is that you will be seeing that will be positionally good for longs. It's still not a continuation for shorts. If the delta is somewhere less than, in case of Nifty, if it is less than minus 10,000, then they are not aggressive delta. And aggressive, if the institutional participation is there, you will be seeing that the delta becomes 15K, minus 15K or minus 25K. Then we can say that those entire aggressive movement is driven by institutions. But if something like minus 7,728, maybe it could be driven by emotional sellers. Right? Maybe that particular day, the aggressiveness would have been there from the emotional sellers. They would have been driven down. That is the reason we are also seen anomalies. If you look into the market profile, I'll pull up the market profile charts. So if you, not now, but if you look into the market profile charts, there are 4 anomalies we spotted out yesterday in Nifty futures. Right? So that particular day is driven by emotional sellers. That is what it says. The aggressive sellers are nothing but emotional sellers. Who could be on the other side is mostly the limit order buyers on the other side could be institutions. They might be trying to observe all the selling activity come from the emotional sellers. All the emotional selling activity could have been observed by the counterparty. Counterparty could be institutional players who are not controlling the market as of now. Maybe they might take control from Monday onwards, but as of now, they are the counterparty. They could be on the other side. That is the only thing which we can gauge from the cumulative delta. And that cumulative delta behavior varies for Nifty, it varies for Bank Nifty. So I'm talking here from the Nifty behavior perspective. Maybe that particular day in Nifty futures or who are pushing aggressively are right on that intraday basis, but they could go wrong from a positional perspective, right? This is, I'm talking only related to Nifty. For other symbols, it could be different because the institutional behavior varies from symbol to symbol. But if it is for a Nifty future stock, a lower cumulative delta, anywhere between minus 4,000 or minus 7,000, which is not a positional good continuation. That is one of the stand which you have to make on. One of the reason I said like go neutral. We cannot trust this downtrend which happened on last Friday because we had a rally high, we had an anomaly, and the delta is negative. All are pointing that, which is not a good sign of a downside continuation. You can use cumulative delta only for to check whether to carry forward position or not. Not every day, but there are certain days like an earnings season. If you are seeing it in a good earnings season, what you'll be seeing is the cumulative delta every day. Cumulative delta every day keeps going down, whereas the price keeps going up in an earnings season. Right. So maybe I'll go back to the slide and I'll show you. So if there is one more indicator called Bell Delta, which talks about the historical cumulative delta formation how the cumulative delta is behaving. If I draw a candlestick only about cumulative delta, how the price behavior would be. You would have been seen that many times the cumulative delta goes down and the market keeps going up. So that's how most of the time you'll be finding this behavior, especially during earnings season. If the markets are about completely bullish, market completely keeps going up and up and up and up. But if you see the cumulative delta, they continuously keeps going down and down and down. This behavior is observed only during earnings season, and there are set of season before before any event is about to come. We will have this kind of cumulative delta patterns where in a strong downtrend, cumulative delta keeps going down. think we can stop here, and in the afternoon we'll discuss more concepts, more trading concepts there. And one of the thing I would like to show you is, let me close and reopen this Ninja Trader. I'll show you how the bell delta looks like. Ninja Trader. With this, we'll stop the session and we'll go back to lunch, and we'll start the session again by 2 o'clock. So when you're installing Ninja Trader usually comes with both 32-bit and 64-bit. Most of the data vendors, they support both 32-bit and 64-bit. So simultaneously, you can use 32-bit or 64-bit. It doesn't matter. But 64-bit will be even much faster, which is also a recommended one. I mistakenly opened 32-bit, but I prefer using the 64-bit. So one of the charts here is a bell delta charts, which I'm going to show you. Which you'll be seeing that recently there are no much patterns. We are seeing a lot of sideways activity. In Delta also, it is not, you're not seeing any clear pattern over there as of now. No trend is emerging, so markets are completely sideways. And Delta, the cumulative Delta is also getting sideways. There are no clear pattern emerging. But if there is any clear pattern emerging, what generally happens is that when the market goes up, and the delta goes down. This is a typical pattern you will tend to see in a good uptrending markets. So far, price is also going sideways, and the cumulative delta is also going sideways. Means nobody is in active control in the markets. Nobody is doing accumulation or distribution. The aggressive players are not accumulating. The aggressive players are not distributing. But what we're seeing is an continuous whipsaw in the cumulative delta. The cumulative delta is completely going sideways. Markets are also going sideways. Means no aggressive participants are taking control in these markets. That's what it means. Again, I'm going to stop the session here, and we'll take questions in the afternoon session. And session starts by 2 o'clock sharp, and be there at time.